gonna get one of those TAG thing like that right now. Bottles. The audio is gone.
I know.
We're starting. 2 minutes past. We're starting.
Yes, sir.
2 minutes past.
Good morning, ladies and gentlemen. My name is Colleen Williams. I currently serve Tax Administration Jamaica as a senior technical specialist with portfolio responsibility for training and publication. Good morning, ladies and gentlemen. My name is Colleen Williams. I take the opportunity this morning on behalf of the TAJ team to welcome you all to this session entitled Payroll Tax Administration of Payroll Taxes and Contributions. Now, for persons who would have been at our sessions, the last two webinars that we would have had, you would have realized that a number of the questions that were posed were in relation to this topic. And so with that in mind, we took the decision to host a session to explain payroll issues. So I can say this morning that you have asked and we have listened and we're here to chat today. But before we go into our chatting, let us just, look to our Heavenly Father. Let us pray. Merciful, kind, loving God, our Father and our Savior, we thank you for this privilege, Almighty God, that we can gather this morning in a fashion like this. Lord, we look to you. We acknowledge you as sovereign. We acknowledge that we are human, but Lord, we can do all things through you who strengthens us. We ask, Almighty God, for your direction, for your guidance, for your control. We ask, Almighty God, that you will just be with us today in all our deliberations, Almighty God. We ask that the content will be explained with clarity, that it may aid understanding. We pray, Almighty God, that at the end of the day, we will all be able to say it was good for us to have been here. Thanks now for hearing us, we pray. In Jesus' precious name, amen. Okay, so at this point, I also want, having recognized my first team member, my chief team member, I also want to recognize our other team members. You have the VEST team, the Virtual Event Support team, including Ms. Kezia Bile, Leslie Ann Robinson, Adrian Dunbar, and Damian Newsome. Also with us this morning, we have our chat monitors, and they are Courtney Johnson from our Spanish Town tax office. We have Marie McDonald from our Mandeville, I beg your pardon, tax office. And then we have Grace Smith from the technical specialist unit. So they will be addressing your questions in the chat. Now, just by way of housekeeping, We will be taking a 10 minutes break somewhere about halfway into the session. And that's an approximate time because we'll just stop at a convenient point so that you can, do your bathroom break, get some water, whatever you need to do. So again, welcome. We do look forward to a very engaging session. And we know that we are confident that, we will all benefit from this session here today. So I will now move to the presentation. Okay, so as you have been told, we'll be looking at the administration of payroll, taxes, and contributions. All right. And by way of our objectives, what do we want to accomplish today? Our first objective is that we are going to be explaining to you with the hope that you will recall the legislative authority for most of what we will be saying. Now, we know that you will not necessarily remember everything that has been said, but if you can remember the legislative authority, you'll be well ahead of the game. The other thing is payroll is a vast topic, and there is no way that we can, in this short session, address everything that needs to be addressed. And so what we will do as we go through the presentation, you will hear mention being made of the legislative authority. The other thing is that, we hope to make a distinction between contract of service and contract for service, because we understand that that is where a lot of our customers need clarity, because they may be treating somebody who is on a contract of service as a person who is on contract for service. And so we hope to, clarify that for you today. We also want to identify those items that are considered to be emoluments, because after all, payroll, taxes, and contributions are computed on emolument. So what is emolument? What do I consider? What should be included as emolument? Also, having an understanding of what constitutes emoluments, we also need to be aware of what is subject to tax and what makes it subject to tax as opposed to what is not subject to tax. Then we'll also be looking at some benefits in kind. When the employer pays you something, then pays you money, it is easy for you to identify that as emolument. But what about when the employer provides you a service or gives you a benefit that is not necessarily in monetary form? How do you account for that? We're going to be looking briefly at that in respect of 2 items today. And to cap it off, we're going to be looking at how to accurately compute the taxes and contributions. There are questions out there about what should be taken out. Should I take the NIS before I compute the education tax? Or should I take what do I compute on gross or net or statutory income? But we hope to clarify all of that for you today. All right. So moving right into it. And before we continue further, I will be stopping at intervals to take questions. So you can go ahead and put your questions in the chat or in the Q&A. You can go ahead. Those will be monitored. But if you have questions that you would like to verbalize, I will stop at intervals to take those. All right. So continuing, when we look at the engagement for the provision of services, there are 2 main types of contracts. You have the contract for services and contract of service. Now, which one, how do we know which one is at play, right? First of all, we will look at contract for services. That is where you have an independent contractor. He acts as a self-employed person. He's self-directed and bears all the risk of what he does. When you think about a plumber, recently I had to call a plumber to come to my home to fix something. No, I did not provide any direction, supervision, or control for the plumber. The only thing is we agreed on the time when he should come because I need to be there to open the door to let him in. And I need to be there. But that is the only thing. There was nothing else that I had to do with what he did to fix the pipe. I showed him which pipe to fix, and he fixed it. I didn't tell him how much tangent or which tool to use or anything. He was employed on a contract for services. So he is required to account for his taxes and statutory contributions by himself because he's self-employed. A person who is employed on a contract for service, on the other hand, is considered to be an employee. There's an employee-employer relationship. And in that relationship, the employee acts on account of the employer who bears the risk of what he does. Another thing is the employer provides direction, supervision, and control and the tools for completing the task. As a result of that, the employer is obligated to account for payroll taxes and contributions. So I am employed to TAJ. I come here, the TAJ sets the time when I am to come here, and they set the time when I am to leave. They have their standard operating procedures, which I must be guided by. They do provide direction, supervision, and control over what I do, right? And so they are my employers. They are obligated to withhold. Now, I will not go deeper into, the distinction between those two, but if you are so minded, there are two recent cases, and not only are they recent, but they are Jamaican cases that you can, in your time, read to get a little more insight as to the distinction between the two. They are the National Housing Trust versus Marksman, and that was a very popular case. If you flew over Jamaica at the time, you would have heard about it. And then there's another one, Jamaica Inn Limited versus Commissioner General Tax Administration, Jamaica. So you can read those two cases or any of those two to get a little more insight as to, what constitutes contract of service. All right. So we did say that once a person is employed on a contract of service, then the employer is responsible to do certain things. Now, before we get to that, the terms of a contract for the provision of service is ultimately determined by it is the terms of the contract that ultimately determines what type of contract it is. So it is a matter of fact. It is not a matter of what persons may think or what they would choose to observe in the particular matter. It is a matter of fact. Is there direction, supervision, and control? Yes. Well, it is a contract. There are no questions. It is a contract of service. Now, where the engagement is a contract of service, the employer is obligated to carry out his duties as stipulated in the second schedule to the Income Tax Act. And that is another legislative authority that I want to be etched in your mind, especially as payroll service providers. You cannot be a payroll service provider and not be aware of the obligations of an employer under the Income Tax Act, because that is where everything is outlined. Now, in terms of the obligations, I'll just go through a few, but I'm giving you homework. Before the teacher starts, you're getting homework. Your homework is to get your hands on the second schedule to the Income Tax Act and read through that second schedule. You don't have to do it in one sitting, but, you know, be familiar with what it says. So in Regulation 7, in the second schedule, it speaks to the employer's obligation to deduct and remit income tax, PAYE. Regulation 14 speaks to the administrative requirements regarding the deduction and payment of income tax. It speaks about the fact that the income tax is to be deducted, it is to be computed using the cumulative approach. And for those of us who would have been on the last session, we would have explained that. And Regulation 18 basically indicates that, you know, the employer is required to give the employee a P45 at the point of his termination during the year, so that that P45 can be taken to the next employer to aid with the computation of the person's related PAYE. And Regulation 25, and then there's the regulation that speaks to the SO1 being required to be filed by the 14th of the month following. And then I think it is 29 that speaks to the filing of the SO2 at the end of the year. So everything that we ask the employer to do is grounded in the regulation. It's grounded in the regulations in the second schedule to the Income Tax Act. And so, you know, the encouragement, I cannot overemphasize, as employers, as payroll practitioners, that is one part of the income tax legislation that you need to be familiar with. All right, so having said that, we will now move into emoluments. And again, you will see here that we're going to be speaking to Section 2. In terms of the definition for emoluments, we look to Section 2 of the Income Tax Act. Never forget that the definition for emoluments is found in Section 2 of the Income Tax Act. From time to time, we do get calls here where persons are asking, is this emolument? How should we treat this? So we're going to be teaching you today. We're not just going to be giving you a fish today. We're going to be teaching you to fish. So before you make the call, we always welcome the calls and we will respond, but we're going to help you to help yourself, all right? And so Section 2 is where you'll find the definition for emoluments. And it stipulates that emoluments includes payments made in relation to an office or employment of profit before we go to the such as. So it is a payment that is related to your employment. So it is not the self-employed person who is not employed anywhere, because you do have persons who are self-employed, but they have an employment. That's not the person I'm talking about. The person who is purely self-employed does not have emoluments. Emoluments is a term that is specific to the employee-employer relationship. It is what the employer pays the employee. So it is not correct to refer to any other income as emolument. So what does emolument entail? All salaries, wages, fees, provision, or payment in respect of living expenses, perquisites, and benefits, whether in cash or kind. Remember, I spoke earlier of the benefits in kind. So emoluments can be in cash or in kind, right? And the others goes without saying. Your living expenses, to the extent that your employer pays living expenses for you, the employer is giving you a monetary benefit. The employer is saving you from spending money. So whether the employer puts money in your pocket or saves you from spending money, then that accrues a benefit to you. Now, all sums, it also includes all sums paid by an employer in respect of expenses, whether reimbursable or not, right? It also includes annuities, pensions, superannuation, and other allowances payable in respect of past services, whether legally due or voluntary. And I want to pay attention to the fact that it is not necessarily something, it does not have to be something on your employment contract for it to be an emolument. It can be a voluntary payment made to you by the employer, and it is still to be treated as emolument. It is still regarded as emolument. Now, for those who would have been on the last two sessions that we had, I did indicate that pension income is emolument. Even though for most persons, they'll be getting it after they would have ceased working, it is still considered emolument because it is in relation to employment. No, it also includes lump sum paid in commutation of pension or other periodic sum. So as we had said before, pension is emolument. So if you decide not to take the pension over time, but you decide to take a lump sum upfront in lieu of that pension, then that also constitutes an emolument. Of course, there are some other rules and regulations governing that, but we will speak a little bit more on that later on. Now, payments. The second bullet here on the slide speaks of payments of cash or kind. Remember, see, this kind keeps coming up. Payments of cash or kind to any person being the holder or past holder of an office, where this payment is made in connection with the termination of the holding of an office, otherwise than by death. So if the payment is made in respect of a person dying in the line of duty, that is not considered emolument because that would be by death. So once it is that you cease to hold office and it is for any other reason than death, then it constitutes an emolument. Also, so that is where we spoke of the holder or the past holder. So what we just explained a while ago would have been consistent with where you're a past holder. We say if you're a past holder and you get monies, then it is considered emolument, except where your termination is as a result of your death. But for the person who is the holder of an office, any monies that would have been paid, right, in relation to a change in the nature or the terms of any undertaking to that person for his future conduct. So one of the examples that comes to mind with this second part here is, you know, some persons are given things like shares in companies, and that is usually like, you know, senior managers or so, or anything can be given as an incentive more or less for future conduct, for you to ensure that you meet the sales target, for you to make sure that, you know, the organization meet a particular goal, then that also is considered an emolument. Now, for the last bullet here, the payment is treated as being made to the employee. So we're talking about now who the payment is made to. It is made to the employee as long as he is alive when the payment is made. So even if the payment is made to my husband, to my child, as long as I'm alive, it is deemed to have been paid to me as an employee. All right, I know the questions will come, but some examples of emoluments are screened here. I will not necessarily be going through all of them, and some of them we can relate to. Certainly the bonus, the credit card, the overtime, and I did make mention before of shares. When an employer gives you shares in the company, it is an emolument. The value of the shares is an emolument to the recipient. It becomes an emolument at the point where the shares are vested, meaning the time when the person has full benefit of the shares. Because sometimes, you know, the shares are not vested immediately, they're vested over time. So it is when the shares becomes vested that they become emolument to the recipient. All right. So Section 2 provides a definition for emoluments. And it pretty much stipulates that it is a payment made by the employer to the employee in relation to the employment. And if I might just step back a little, we spoke about shares in a company. A company may give shares to its employees. Now, the value, and we did say that the value of the shares when they are vested becomes the emolument. But let me just hasten to say that in the future, after these shares would have been vested, and the same company decides to pay out dividends on the shares, that dividend is not considered an emolument because that is as a result of the shares, the person holding the shares. So that is not considered an emolument to the person, the dividends that are paid. But because technically the person now becomes an investor in the company, and the dividend would be as a result of that investment and not as a result of the person's employment. All right, so moving on now, having established what is emolument, what are emoluments, then we're now going to be looking to Section 5 of the Income Tax Act, and it is Section 5(1)(c) that brings emolument into charge for income tax. So the general rule is that emoluments are subject to tax. However, like with most other things, there are exceptions to the general rule. And we find some exceptions in Section 5(1)(c) itself. So Section 5(1)(c) brings emoluments into charge. But there, so it will say emoluments are subject to tax, except, and we're going to be going into some of those exceptions. Also, there might not be a full exception. So it might basically indicate how the tax is to be computed in respect of a type of emolument, right? So you might find that the full amount may not be taxable, but to the extent that that is the case, Section 5 does explain how that particular item of emolument is to be taxed, how it is to be treated for tax purposes. We also have Section 12 of the Income Tax Act that makes some emoluments exempt from income tax. So remember now, Section 5(1)(c) brings the emoluments into charge, but there are some exceptions in 5(1)(c). In addition to that, there are also some exemptions in Section 12. And in the second schedule, Regulations 8 and 9 that gives the Commissioner General the authority to, on a discretionary basis, to make some items of emoluments not subject to tax. And we're going to be talking about those. I am sure the traveling allowance is now jumping up in your head. That it would be one of them, but we'll come to that at a later point in the session. So we are going to be looking first at some of those emoluments for which there's an exception to it being subject to tax in section 5(1)(c). But before we continue, I trust that you guys would have been posting your questions in the chat. Is there anybody with a burning questions? We could take 2 of those before we proceed. Any burning questions that you'd want to voice before we proceed? Anisha, go ahead.
Good morning, everyone. It's just to reiterate. So when you made mentions regarding the stock, I understand you said the dividend that is paid on it, that's not taxed. However, the stock that is issued, I'm talking about the employees who get receive stocks.
Right.
And they was, in my case, they're normally in kind because they don't tangibly get it. It don't mature until a couple of years. In that case, on a yearly basis, when they are issued these restricted stocks by the company as one of their benefits, the whole sum of it is taxed. It is considered in kind, but the dividend from it is not taxed, correct?
Right, that is correct. Because the dividend is not an emolument. The dividend is the same dividend. If somebody who is not employed to the company holds shares, they would be getting similar dividend in a similar way. So it is not, the dividend is not as a result of the employment, but as a result of the investment. So you are correct. Any other burning questions? We're moving right along. Colin Coley, go ahead. Colin, unmute your mic and go ahead.
Okay, hello?
Yes, I'm hearing you.
All right, so let me get this, So the dividend the employee receives, okay?
Yes.
You say that when should that employee file a ITO one at the end of the year, ITO 2, and then declare those dividends?
No, I am saying it is not. Remember, we were discussing emoluments. So I'm not saying it is not subject to tax. Because whoever is paying the dividend would be required, to the extent that it is the ordinary dividends, that the company would withhold the payer of the dividend, which turns out to be the employer of the person, would be required to withhold the 15%.
Okay.
All I'm saying, I'm not saying the dividend is not subject to tax. I am saying it is not classified as emoluments.
Okay, all right.
Because remember, we were trying to make the distinction between what is emolument and what is not emolument.
So, because the employee did not earn that money during offering services, so it's not considered emolument.
It is not as a result of the employment why that person got the dividend.
Okay, okay.
It is as a result, it may be it would be as a result of the employment why the person would have gotten the shares initially.
So the employer will withhold the taxes from that dividend.
Pardon me?
The employer would withhold the taxes from the dividends.
Right. The employer would just like, so if you are employed to the company and the company has gifted you some shares, I am not employed to the company, but I buy shares in the company. When shares are distributed, dividends are paid, I would get dividends, you would get dividends. The company that is paying the dividends would be required to withhold from both of us.
Okay, Okay.
So the distinction is that the shares, the gifting of the shares to the employee is an emolument. The gifting, not where the employee buys the shares, no, but the gifting of it is an emolument, but the dividend that flows from the employee having those shares would not be considered emoluments.
Okay, but all right, I'll
Those
just
taxed under a different provision under the income tax.
okay, good. But with the employee now,
Not as emolument.
Hello? Can you hear me?
trust that has been made clear.
Yeah, but can you hear me?
Question.
But I'm saying when the when the ITO2 is being filed, would the employee declare those dividends as income?
So the employer would have withheld tax at source from the dividends, right?
Mm-hmm. Yes.
Right. So to the extent that the employee has the employment income, the dividend income, and some other source of income, and is required to file his S04, then he certainly would be required to declare the dividends on his S04. But he would have a withholding tax certificate
Okay, to claim back those taxes, claim the tax
substantiate the
credits.
credit in respect of the tax that would have been withheld on the dividend.
All right, thank you. I understand.
You are most welcome. All right, so we are going. Colleen, my namesake? Oh, you're gone. You don't want to talk to me, Colleen? All right, so I guess we'll talk later on, Colleen. All right, so we're moving ahead now into the emoluments, the treatment of some types of emoluments under Section 5(1)(c). Remember, the general provision is that emoluments are brought into charge for income tax. However, there are some circumstances under which, the emolument or a part of it may not be subject to tax. Okay, so we will take questions at another interval. So, Colleen, you have come back. I'll take the question short. Or your question. All right. So, some of the treatment of some items under Section 5(1)(c), we're going to be looking at meal allowance, uniform allowance, telephone and rental charges, lump sum payments, credit cards, accommodation, motor vehicle. Sounds like a mouthful. But that is why I'm giving you the sections so that you guys will have the benefit of being able to read in your time. All right, so let us take meal allowance. I love steamed fish, and you would pick that up from my slide, right? Yes, that would be ideal lunch for me. All right, so meal allowances are not taxable under the following circumstances. When paid in relation to work done outside of normal work hours. Now, that is very important. So to the extent that an employee has to go outside of his normal work hours, but what is normal work hours? It's not just the time of day. So if you are scheduled to work the graveyard shift, or you're scheduled to work night shift and morning has come, and you're still required to stay beyond the time that you would leave, be it 6 o'clock or whatever time you would leave, that is outside of your normal working hours. If it is that you're required to work from 9 o'clock to 5 in the day or 8:30 to whatever time, and you're asked to go beyond that, that is outside of your normal working hours. So normal working hours will vary from situation to situation. Where the employer operates a canteen or a subsidized lunch program, and it is not possible to quantify or trace the benefit to a particular employee, it is not administratively possible to assess those employees. Right? The employer buys chicken, fish, beef, the seasoning, and the rice, and everything that they use to cook the food. Now, how much of it did I consume? If you cannot quantify how much of it an employee has consumed, you cannot assess the employee on that. However, where there's a lunch voucher situation, where the employer issues the lunch voucher and it is quantifiable, the value of that is taxable. I know that now we don't have so much of the paper lunch vouchers anymore. What we have now are electronic cards that are given to employees, and they are topped up monthly or periodically. You know, a fixed amount is put on the card, then that becomes taxable to the employee, right? Once it's not for use outside of normal working hours, it is the regular day-to-day provision of meals for the staff, then that becomes an taxable emolument to the employee. Because Section 5(1)(c) only makes provision for it to be accepted where it is for work done outside of normal working hours. Uniform and laundry allowance. For most of us now, ladies and gentlemen, this is really not a tax-free item. So the amounts up to the specified limits paid to some categories of employees are not subject to tax. Notice it is the specified person, not to all of us. Now, these employees are those who fall within the category specified in Appendix B of Part 1 to the second schedule. Remember now, second schedule is very important to payroll practitioners. Now, that listing consists of people like firemen, porters, I think the persons who work at the airport, persons who need to wear protective clothing, or they need to wear clothing for identification and that, right? So, and it also says that any other employee approved by the commissioner where he's satisfied that they are required to wear a uniform in the interest of safety, security, public health, which would be consistent with the list that already exists, right? So to the extent that that approval is given, then the exemption would be allowed as well. Now, I know that you're going to, these amounts seem minuscule, and I keep saying to persons that when this came into effect, when these amounts came into effect, they would have been relevant. Now, I will agree with you that they are minuscule, and but for uniform, the exempt amount is $5,739, and for laundry allowance, it is $3,395 per annum. Where the uniform is supplied or allowance is paid by employers and the employee falls within the exempt category, any portion of the cost or the allowance that exceeds the exempt amount is subject to tax. Same thing for laundry. Where the uniform is supplied or the allowance is paid and the employer, by the employer, and the employee does not fall in the exempt category, the full amount of it is subject to tax. So essentially, most of us would not necessarily fall in that category, but again, I encourage you to go to the second schedule and look for the listing of persons who would be entitled to that exemption. Now, as it relates to telephone call charges, where an employer assigns a telephone to an employee and the employer pays the charges. Now, if you go to the legislation, it will talk about the employer putting a phone in the home of the employee for the purpose of, being able to, for the employee to be able to carry out his official duties. But things and times have changed. And I think for most organizations, what has happened now is that persons would be given a CUG. So the same principle applies, right? If the calls that are made with the CUG, or to the extent that they are made, the calls are for official duties, that's not considered an emolument. But the portion of the payment for the employee's private calls would constitute an emolument. And so that is pretty straightforward. All right. Also, where employees use a sum, their organization allows for they're operating under the Employee Share Ownership Plan Act, and the employees are allowed to purchase shares in the company. No, this is not the gift that we spoke about before. This is where the employee now purchases shares in the company under the Employee Share Ownership Plan Act, right? That the amount of money that the employee uses to purchase the shares, that would not be subject to tax, and there's a deduction for it. For those of us who are payroll practitioners, we would be aware of the deduction for NIS, and that before you compute the tax, there will be a similar treatment accorded to the amount of money that is used to purchase ESOP shares. And we now move on to lump sum payments. Now, lump sum payments made by an employer to an employee or former employee falls within the definition of emoluments and are subject to tax, as we would have said. And the lump sum payment is any payment other than a periodic payment. There have been minor adjustments to that, but we won't get into that right now. Of course, again, there are exceptions, and we're going to be looking at some circumstances under which a lump sum payment is not subject to tax, right? A lump sum payment is not subject to tax where it is paid out of the consolidated, meaning the government fund, as well as a designated public fund or account. So once a fund or account, a number of our agencies, government agencies, they are income earning, they have ways of earning income outside of what they are provided with through the government funding. So to the extent that the income that they earn those funds are designated to be public funds, and the lump sum is paid out of that, then it is not subject to tax. Or if it is paid out of funds from the consolidated fund, or monies from the consolidated fund, just to be a little clearer. Secondly, where the lump sum is paid by an employer to compensate the employee for having suffered permanent physical or mental incapacity in the execution of their duties. That too, based on paragraph 3D of the income tax termination employment order, would not be subject to tax. So those are two instances where lump sum payments would not be subject to tax. However, there's a third scenario here where the full payment or a part of it the payment may be tax-free. And this is where lump sum is paid by an employer to or in respect of a person as a terminal gratuity for severance pay, redundancy pay, or compensation for wrongful dismissal or otherwise loss of employment. Now, a number of you might be familiar with the whole redundancy payment, but the others that are mentioned here would be treated in a similar way to how you treat with the redundancy payment. So here we see that it is possible for a part of the redundancy pay or the severance pay, whatever it is called, compensation for wrongful dismissal, or, you know, for payment for otherwise having lost your employment. Those are treated with according to this table. And the parameters that we take into consideration are the length of service, the average annual emoluments, and that determines the tax-free portion. Now, I trust that you have your pen and your paper because we're going to be doing an exercise. Now, what we have done, this information has been extracted from the legislation. We have just simplified it in a table. It is taken from the Income Tax Termination of Employment Payments Order 1971. So you can look that up in your time. Right. So for persons who would have been employed for less than a year, regardless of what their average annual emolument is, there is no tax-free portion. Also, if you have been employed for anywhere between a year up to 3 years, there's also none. Now, the legislation sets it out like this, and that is why the table is written like this, because we could easily say for 1 to 3 years, there is no tax-free portion, right? Once it is under these circumstances here, the redundancy, the compensation for wrongful dismissal or gratuity. All right, so where the person has been employed for a minimum of 3 up to 33 1/3 years, and the average annual emoluments is greater than $7,000. No, that is a figure too that needs to be looked at, because everybody, I mean, your monthly salary is greater than 7,000, let alone your average annual salary for 3 years. So once you have been in employment for 3 to 33 1/3 years, and your average annual emoluments is greater than $7,000 for the last 3 years, then the formula that is used to compute your tax-free portion is 2 1/4 times the average annual emoluments for the last 3 years times the period of service over 33 1/3. I give you a little time to look at that formula. Two and a quarter times the average annual emoluments for the last 3 years times the period of service over 33 1/3 years. Where a person would have been in employment, would have served for greater than 33 1/3 years, then any amount of the average annual emoluments, it does not have to, there's no limit or any ceiling in relation to your average annual salary, but the tax-free formula would be, the formula to complete the tax-free portion of that payment would be 2.25 times the average annual salary for the last 3 years. You don't have to prorate it in. Once you would have worked for more than 33 1/3 years, there is no need for you to prorate the payment. So I wanted to pay keen attention to the formula. And for those who would want to take a picture of the formula, because we're going to be using it to do some work. The formula where the person would have been employed for between 3 and 33 1/3 years. That's the most popular one that we see in our daily lives. So you have work to do now, and I trust you have your pen and your paper. So this exercise reads, Mark Anthony was employed to ABS Limited for 15 years before retiring in December 2023. In recognition of his excellent service over the years, a terminal payment of $6 million was made to him. His average annual salary for the last 3 years was $4 million. So he worked for 15 years. He got $6 million as his terminal payment, and his average annual salary over the last 3 years would have been $4.5 million. You are required to compute the amount, if any, that is subject to tax, the amount of the $6 million. And what you need to do is to plug the information into this formula that is given in the 3rd column and the 4th row of this table. So it's 2.25 times the average annual salary, which we saw to be $4.5 million, over times 15 over 33 1/3. And I'm going to ask you to do the math and tell me how much of the $6 million, if any, would be tax-free. And you have a minute, 2 minutes to do that. And as soon as you would have you have an answer, I'm going to ask you to raise your hand so that you can be acknowledged. Nadine Gordon.
Yes, I worked it and I got 4,556,705.67. It's tax free.
How much of it?
4,556,705.
705. Okay. Our figures look pretty. Any other figure? Anisha, go ahead.
Not far off from her is 4,556,705.67 cents.
705.67. That's 2.25 times. How did you get that, Anisha?
2.25 times 4,500,000 times 15 divided by 33 1/4 and 1/3.
33 1/3.
Yes, 1/3.
Okay. All right. Yes. Maureen?
I got the same answer.
You got the same.
4,556. Are you hearing me? Hearing me?
Yes.
Okay, 4,556,705.67, or rounded off to 706.
the 706.
Yeah.
All right. Okay. You are. All right. So go ahead, guys. You would have done the work. Tell me what you got. Alexia?
Hi, good morning. All right, so the amount that will be subject to tax is 1.949594.
594. Okay. So of that 6 million, that is the amount that would be subject to tax. Anybody else? Go ahead, Shireen.
Good morning.
Yes.
I got 4.556254.56.
2.456. All right.
4.556254.56. The taxable amount.
254.
4,556,154.56.
Yes.
154.56. That's what I got.
Okay. 4,556,254.56. 254.56. Okay. All right. Yes, you guys are you're on point. There's might be some rounding issues with my figures, but essentially you would have gotten it. That is it. And so what you find here now, it is the difference, the taxable amount that would be put in the payroll, not the $6 million, right? So it is the taxable amount that would be included in the payroll as the amount. And to the extent that the person's salary, this is paid at a time when the person is also getting other emoluments, it is possible that there might not be any NIS being applied to this because the other sources of income would have been applied. The other sources of income would have covered your NIS requirement. But for the most part, this 1 million, we have a rounding difference here. This 1,443,700, whatever the figure that you have, would be subject to all the taxes and contributions, subject to the fact that the person is within the age range to pay those taxes and contribution. And we will be looking at age ranges later on. So thank you very much for your participation. You did very well. Now, as it relates to credit card, where the employer provides a credit card to the employee and it is used solely for business purposes, including business entertainment, and the payments is not considered emoluments and is therefore not taxable. It is for business. You use it to do the company's business. You are not getting any direct benefit from it. So that is not a taxable benefit on the employee. But where the employee uses the card to acquire goods and services for both business and personal purposes, the payments that are of a personal nature as well as the associated charges are taxable emoluments. So let us say TAJ gives me a credit card and I can use the credit card to do things for TAJ. Government does not allow that. We have a tight auditing thing and monetary policies. But just, let us, act for a while. Let us, think about it as being remotely possible. If I get a credit card and I'm able to use it to pay my child's school fee, to go to the supermarket, to pay for things for the business, then what this is saying is that not only the charges that the company pay for me for the card, that is an emolument to me, but also the financial charges that would accrue to that account by the bank would also be an emolument to me. All right. And then we go to accommodation. We go to accommodation. And we're still in section 5.1c. Section 5.1c covers how accommodation is to be treated. And it says where an employer pays rent in respect of accommodation for the employee, and that accommodation is not required for the performance of his duty, the full amount of the rent paid is an emolument. So once it is a perk that the employee is given, the full amount of it is subject to tax, is an emolument subject to tax. But where the employer owns premises that is used to provide accommodation for the employee, it is the taxable amount, the taxable value is deemed to be the market value. So in the first instance, the employer does not own the premises. They just pay rent at some apartment or something for the employee. That is the benefit, the taxable benefit of that is what the employer pays. But this second scenario here is where the employer does not pay rent, but the employer owns the premises and allows the employee to live in it free of cost as a perk. Then the taxable benefit would be the market value of that accommodation. And how would we determine market value? What would, for example, the rent be in that neighborhood for that size house, for that, type of accommodation? I trust that that is clear. No. Another scenario is where the employee is required to live in the accommodation provided by the employee, where the employee is required to live in accommodation provided by the employer, and it is established that it is necessary for the employee to have the accommodation to exercise his employment, the value of the benefit shall not exceed 30% of his emoluments. So what you see here is the difference between this and the two scenarios that we looked at before is that in this instance, the employee is required to live in the accommodation provided by the employer in order to execute his or her official duties. Here we are saying that the employee is not to be assessed on the rent paid or the market value. What they are to be, there's a cap. And the cap is that the assessable benefit shall not exceed 30% of the person's emoluments, not including the accommodation. Now, this is a point of that is not so clear for some persons, because some persons are of the view that the legislation means that is saying that you can tax the person at any value up to 30%, and that's not what it is, and that's not the intention. The intention of the 30% is to create a ceiling so that the employee is not to be taxed at market value or at the full rental paid, but there's a cap on the amount that the person can be is to be taxed on, and that is 30% of his or her emoluments, not including the accommodation. Now, where the employee lives in accommodation that is owner operated by a registered charitable organization, The value of the benefit also shall not exceed 30% of his emoluments. So this again is another capping. Right. So the portion of the market value of accommodation to be assessed as a benefit to the employee should not exceed 30% of his emolument, right? Not including the accommodation benefit. So you think about situations where persons are required to live like, you know, night managers, duty managers. You think about situations where you have a 24-hour manufacturing situation and you need to have a manager on the plant or close by, you know, just in case there are any eventualities, or somebody there who is in a position to take decisions should those need to be taken. And you don't want the person to have to travel from far in case there's an emergency. So there's a need for the person to have the accommodation. But the person lives in the accommodation, and for whatever, in some cases, they might have their family, they might, you know, there is a private element to that in that situation. And so the person is to be assessed on a benefit. However, having recognition to the fact that the person is required to live there primarily for the purpose of executing his or her official duties, then there is this 30% cap. All right, so so there's a 30% cap where you're required to live in the accommodation. In the case of a charitable organization where the person is required to live in the accommodation, 30% cap. But let us go to ministers of religion. There is a different treatment for ministers of religion. So where the minister of religion is required to utilize accommodation provided by the church to carry out the official duties, the maximum of the concessionary value of the accommodation is 10%. Unlike in the other case where we said that it was 30%, it is capped at 10% of the emoluments, not including the accommodation. So you think about situation, and when we say a church here, I guess we could really say places of worship, and some persons might not call their leader minister, they might call them something else. But once the leader of the religious organization is required to live in accommodation provided by the religious organization in order to carry out the duties, then the benefit is to be kept at 10% of his emoluments, not including the accommodation. Right? So where the value of the accommodation is greater than the other emoluments, then the benefit is 10% of the emoluments plus the accommodation. So there's a slightly different treatment here, right? But it is the same principle. There is a capping of the amount because the person might be required to live. Some churches call the church house the manse. Some persons might be required to live in the manse because they host other visiting pastors. They see congregants there, they come for visitation, that kind of a thing, right? So once the premises is required to be used in that way, then the minister of religion is assessed on a benefit, but in this case, the benefit is kept at 10% of his emoluments. Or if the emoluments is less than the value of the accommodation, you average both. So it would be 10% of, well, it would be 10% of the emoluments plus the value of the accommodation. So it's time to work again. We have a scenario here. I trust you can read it. So it says here, Maggie Lowe lives in St. Andrew with her family. She is employed to Sunshine Hotels, which has 3 properties, one in Kingston, one in Mandeville, and the other in Ocho Rios. Miss Lowe was a customer relationship manager in Kingston, but was recently promoted to a senior manager's post and asked to relocate to a property in Ocho Rios to serve as a night manager. She was provided with a living accommodation next door to the property for herself and family. Right? The cost incurred by the employer to provide the accommodation is $300,000 per month, which turns out to be 12 times that would be 3.6 million. Miss Lowe's emoluments for the year are as follows. She gets salary of $4,750,000. She drives a motor car owned by the company, and the benefit of that is $1,140,000, and she gets incentive pay of $1.2 million. Now, should Miss Lowe be assessed on the $3.6 million, which is 12 times 300,000, or something else? And I want somebody now to, based on all that has been explained, how should Miss Lowe be taxed here? We're going to go to the calculations shortly, but I want somebody to explain to me, based on what has been explained before, how do you think Miss Lowe should be treated here? Should she be assessed on the 3.6 million or something else? May I see a show of hands? Anybody wants to explain that to me? Anybody? If I'm not seeing any hands, it means that somehow it was not clear. Timothy, go ahead. Thank you for saving the day.
Yes, good morning. Based on what you had presented, to me, it seems as though the assessment would be on the 300,000, because it would be a bit, my understanding, it would be 30% that this person would be assessed on for this 300,000. I hope I got it
30% of
correctly.
the 300,000?
No, of the total for the year. It should be
30% of the total for the year.
the
All right.
3.6.
Thank you very much, Timothy. Thank you. You're the brave one. You're the first out of the block. Thank you. Anybody else? Cardi Blake? Carl Blake. Carl, go ahead.
Okay, I was thinking that you don't go for the cap. You don't find the cap first before you decide to use the 3 million.
Okay,
First, you have to work out the cap.
the 3. Okay, so 12 times 300,000 would be 3.6 million. That's what the employer would have paid for the accommodation. You're saying to me that before we decide to go ahead and tax that, we would compute the cap.
Yeah.
Okay, and I'm walking down that road beside you, Carl, but let us hear what other persons have to say. Shakira, go ahead.
Could it be 30% of the salary?
Okay. All right. When you say salary though, is it, if you notice, the 4.7?
Mm-hmm.
Okay. Is salary the only emolument that she has?
Oh,
Would have to add in the rest.
Pardon me?
I think we should add in the rest.
Add in the rest.
Yes.
I think so too. Somebody else has a comment? Shakira, go ahead.
We have to calculate all of the emoluments. That's the motor vehicle. We have to look at the salary itself and the incentive. And not only that, I thought I might have missed it. I'm not really sure, but you said something about if she's accommodation is provided and a family is included, she have to consider the portion for the family. I thought you mentioned
Well,
something.
no, okay. What I said is that it is possible. So I did, the benefit is accessible as long as the employee is provided with the accommodation. Right? But in this case, so, and I did make the point that it is possible that the family could have joined the person. So here it is, Miss Maggie Lowe, and I think it was said that Miss Maggie Lowe, she's working in Kingston. She has been asked to relocate to Ocho Rios, right? And it is for her and her family. But the fact that her family is going is not so much of an issue. It's the fact that she has been provided with accommodation, right? And the fact that she has been provided with accommodation, then there is a benefit to her. Because anywhere she lives, she would have to pay, she would be required to pay for utilities. She would be required to buy food. She would be required to pay to maintain the place, right? So what is happening here is that what the legislation provides for is for her to be assessed on a benefit, but not the full cost of paying for all of those things. And I'm going to step back to the slide a little bit just to remind us. Bullet 1 says where an employee is required to live in accommodation provided by the employer, and it is established that it is necessary for him to have the accommodation to exercise his employment, the value shall not include 30% of his emoluments. What I want to point out here is that it does not say 30% of salary, because salary is one emolument. We would have established that this morning.
Yeah.
But there are
Understood.
several different types of emoluments.
Yeah, so
And
that means
so
the motor vehicle would have to be considered an incentive.
that
Because it
is
says
correct.
not excluding 30% of his emolument, so up to 30% of the salary, the motor vehicle and the incentive.
Right. So if you notice now, we're not adding in the accommodation benefit, because it says excluding the value of the accommodation. So it's everything apart from the accommodation benefit, because you couldn't use the accommodation benefit to determine what the accommodation benefit is. It would cause us some circular issues there. So it's all the emoluments except the value of the accommodation that is going to be looked at in order to determine the ceiling, that 30% ceiling. All right, so we go back to the question. So Deborah, you would like to say something? Anybody else? Carl? Carl, is that an old hand?
Oh, yes, it's an old hand. Sorry about that.
Okay, all right. But you're following though, Carl, because you would have responded earlier.
Yes, I'm following. Yeah, that's how I was thinking of working. Adding the salary and the motor vehicle and then find the cap.
Okay, all right. Deborah, you would like to share? Deborah, go ahead.
Yes, I was about to share, but you actually read what I was saying, because I went back to the slide to read that you needed to calculate the emoluments, and the emoluments should not include the accommodation. And then
Right.
the total value should be 30% of what you would have calculated. So it would be that 140. And I'm assuming that's a monthly figure and not an annual figure.
No, it
So
is
you
an
multiply.
annual figure.
It is? Okay.
And I'm going to come to that and show you later on.
Okay. So that's
Yes.
what I was going to add, but you went ahead and said it.
Okay. All right. So, yes, happy to have been able to, you know,
All right, so
clarify that for you.
so the figure that you would be assessed on would be 1,827,000.
1,827,000. All right. Anybody else? Shireen, what did you get?
Good morning again. The accommodation benefit is what my colleague just said, 1,827.
Okay.
And the total to be as total taxable would be 7.917.
Okay. All right. You're on the ball. All right. So the solution. Here we see the salary of 4.7 plus the motor vehicle benefit and the incentive pay would give us a total of $6,090,000. The benefit that the person is to be assessed on based on the legislation is to not exceed 30% of that figure, and you correctly computed that to be $1,827,000. Now, remember the cost of the accommodation was $300,000 per month, so that would make it 3.6 million. So what the legislation is saying here, we don't assess her on 3.6 million. Instead, we assess her on $1.8 million, right? But let me ask you a question though. What if the benefit, the cost of the accommodation was $100,000 per month? How would that change? If the cost of accommodation was $100,000 per month, would we assess Miss Lowe on $1.8 million as has been computed here? And I'm asking you to, use the raise hand feature. Colleen, I see we're going to finally get to talk.
Yes, the value will now be on 1.2 million instead of the 1.8.
Because the 30% is a cap. And if the employer did not incur $1.8 million in providing accommodation, it would not be fair to assess Ms. Lowe on that and the legislation. So that is what, when we say up to 30%, the cap is up to 30% of the accommodation benefit. That is what it means. So if the cost of the accommodation is less, then we certainly are going to assess the person on the cost of the accommodation. But the cost of the accommodation is what is capped at 30%. Right? The benefit, let me say that again. Where the cost of the accommodation, the 30% rule, 30% of emoluments serves as a cap. The employee is not to be assessed on more than that. But where the actual cost of the accommodation is less than that amount, then you go with the cost of the accommodation. I trust that that is clear. And so what we see here, this morning we spoke about a benefit in kind. This is a perfect example of a benefit in kind, because here it is, Miss Lowe is not, we're going to assess her because the 1.8 million is less than the 3.6 that the employer would have incurred in providing the accommodation. So she's going to be assessed on 1.8, but the organization is not putting $1.8 million in Miss Lowe's hand. So it is a benefit in kind. So it will be added to the emoluments in the payroll and tax, but it will also be taken out at the end because you don't want it to inflate her net pay because she's not getting money. It's a benefit in kind. And that's how all benefits in kind are treated, in that you add them into the as taxable emolument, but then you have to take them back out at the end so as not to inflate the net pay. Any questions? Any questions on accommodation? Because this is one that I'd love for you to get everything, but just giving persons an opportunity to ask any questions if there's anything that you're not clear on. Suzette, go ahead. Suzette? Shashara, sorry to spoil your name. My humblest apology. Shashara?
Hello.
Hi.
I am good so far.
You are good. Okay.
Yes, I am. Thanks.
Thanks for responding, Shashara. Really appreciate that. Suzette? Suzette? Anisha, go ahead.
Okay. Don't know if you are going to do a different solution. What if the employee is given a housing benefit, but it's an amount that is given to them?
Could you repeat that for me, please?
All right. It's the employee is giving what would I call it? Housing benefit, a bonus, something that is an addition to. I know a part of their contract, they said that, we will compensate you for relocation. Let me give a more scenario from my company. I have persons who are expatriates, and a part of their contract is that we provide accommodation. It's not that we really are providing, but when they come to the country, they seek the accommodation, the apartment that they'll be staying for the length of the contract, and we pay them this amount to their salary, and they pay the rent.
Okay.
This is fully taxed, right?
So the distinction here is, are they required to live in the accommodation to carry out the duties?
No.
Okay, so that's the bottom line. So if they are not required, when we talk about being required to live in the accommodation, we talk about like caretakers, night managers, persons who have to be physically at that specific accommodation in order to facilitate him carrying out his official duties. And we do get the question a lot of times, persons who have expats who come to the island, and it is more of a helping out the person to settle and that kind of thing. The thing is, the legislation is pretty specific, and it says that you have to be required to live in that specific accommodation in order to carry out your duties.
Okay, noted. Thank you.
You are most welcome. Shakira, go ahead.
Miss, what if you import a service? For example, you recruit someone from overseas to come to work for the company in Jamaica, and you have, the person's not from Jamaica, so you have to provide accommodation. Is that accommodation taxable? And does it go and is it all of that?
Is it, and it is a similar question to what was posed earlier, is that I mean, we don't get into what you put in your employment contract. We're not, TAJ does not get into that. However, it comes down to, we have to assess the situation based on whether the person is required to have that, if particular accommodation in order to do the job. Is it that this person is coming to live on the plant, to live at the premises, to live, because of the nature of the work, the person is required to be close by. That's what makes the determination of how the accommodation is treated. So if you're assisting the person to relocate, and that's outside of the scope of what the legislation provides for.
Okay. I have another one before you move on. It is in relation to accommodation as well. Based on the nature of the job, like the persons who work here, they sometimes come in late at night and they cannot get any vehicle to go home. So the company would rent like a facility where any of them who come in late and cannot get a chance to go home, they would reside there for the night.
All right.
How do you treat a case like that?
For that one, we would need for you to write to us and ask for, and present the situation, because then we're going to have to delve a little more deeply into that. So for that specific one, because you see, guys, sometimes we make pronouncements that are taken and they are used widely. It is something that we would want to manage. So in that situation, I would prefer if you write to us and ask for permission to ask how it is to be treated. Then we will delve deeply into that specific situation and give a private ruling on it. You understand what I'm saying? Hello?
Yes, I understand what you're saying. So you're in that case, you're saying that you can definitively say whether or not
I would not do that in this setting, because there are different, you see, since in my time here in tax administration, I've seen various permutations of that situation. And so that is why I'm saying I would not make a general pronouncement, no. We would have to look at those situations on a case-by-case basis.
So, for example, in our case, we're situated in the dead center of the island in a very remote location.
So all of those things would be taken into consideration. That's exactly where I'm going. That's what I'm speaking to.
Okay.
Right. So it is not a general one size fits all. Because we have several persons on the call, and I don't want persons to leave and say, well, yes, because of that. We have to look at that on a case-by-case basis.
Okay. One other one again before you run. Sorry.
Yes.
As it relates to the meal allowance.
Yes.
I realize I said it's tax-free if it is subsidized and cannot be traced directly to an employee. But what if it is the case where it is subsidized, right? But because the employee has an option to not take up the lunch on that particular day, but because it is contracted, we contract the caterers, right?
And
you have to take individual orders to see what each employee wants on that particular day. How do you treat that?
But can't you then now quantify the amount that because I do understand that there are situations where, especially where you have a caterer, a concessionaire on the premises, there are situations where the organization pays the caterer on a per person level. So you know you're able to say Colleen Williams ate 15 lunches and each one was for X number of dollars. So you can then quantify. Remember now, given that it is not for work done outside of normal working hours, it would be subject to tax. And to the effect, effect that it can be quantified, then it becomes subject to tax. Then it would need to be treated as part of my emoluments.
Even though the subsidized, it's available to everybody, you know, it's just that that person takes it up on that particular day.
But okay, so how is the concessionaire paid? Is the concessionaire just given one blanket sum, or the concessionaire is paid based on the number of employees who eat and what they eat?
Oh, okay, I understand what you're saying. So if they're paid on the number of employees and what they eat, and
Yes.
it is taxable, but if it is just a blank, a 200,000 a month, and you provide any amount of lunches, then it is considered
Right.
tax-free.
So so where the employer provides the lunch and you can't quantify how much any of the employees benefit from what the cost that the employer incurs, then it is not administratively possible to assess the employees. All right. Thanks for that, though. Really appreciate it. At this point, I'm going to ask that we take a 10 minutes break and you refresh yourselves and come back. And my timekeepers are telling me what time to come back. What time? We resume at 11:22. Thank you very much. So we'll start at 11:22 on the dot. All right, so refresh yourselves and come right back.
everything when campaign come up with based on how much as
We lock down the place.
We can't be broke. After all, you will get annoying here too.
I want him to just get
Yeah, we don't need
I'm not
concern on
happy.
a soap.
Why are some people embrace it?
Yes, so welcome back, one and all. We are going to be continuing with our discussion on the treatment of the various types of emoluments. So we would have just completed the treatment of accommodation, and I trust that was understood. And if you have any questions, remember, feel free, put them in the chat, or you can voice them at the point where we are taking questions, the verbal questions. So we're going to be moving on now to motor vehicle benefits. Now, where by reason of employment, a person is provided with a motor vehicle by his employer, and it is used for both business and private purposes, then a taxable benefit, there's a taxable benefit to the employee in respect of the private usage. And the private usage is determined based on a table, which I will be showing you in short order. It's not on the actual cost of maintaining the vehicle. Now, this is not, there are two things I'm going to be talking about here, two benefits, two types of emoluments that relates to motor vehicle. This one is where the employer owns the vehicle and makes it available to the employee for him or her to use it for both official and private purposes. Now, what we're saying here is that the private usage is what is accessible to tax, right? An employee to whom the company, a company owned or leased motor vehicle is assigned to is not eligible for tax-free traveling. So that's the other benefit that, sorry, that's the other emolument that we're going to be talking about. So here we're talking about motor vehicle benefit. We're going to be talking about traveling allowance next. So don't get them confused. All right. So in order to ascertain the benefit associated with the private usage of the vehicle, we look at these three parameters: the age of the vehicle, the original cost of the vehicle, and the employee's level of private usage. And this schedule is also in the second schedule to the Income Tax Act. It's Appendix A. It is right there in the Act. And so I encourage you to, familiarize yourself with it. Now, if you notice, we said that it is based on the cost. So we have the original cost on my left, and you have cost from $300,000 up to $1.5 million. I guess this part of the table can also be looked at in terms of our current realities. I will agree with you that, that needs to be done. This table might need to be revised, but legislatively, this is what we have at this point, and this is what we're working with until our change comes. So we look at the cost of the vehicle. For the most part, I would say, I'd assume, I may be wrong. In my humanness, I can be wrong. But for the most part, I would say most of the vehicles that a company would be assigning to an employee in today's day and age, in 2024, is going to cost over $1.5 million. And I said most, not all, but most of them would cost in excess of $1.5 million. So when you look at if the vehicle is under 5 years old and there is up to 50% private usage, then the assessable benefit to the employee is $120,000 for the year. Now, for those of us who drive, we would like to drive our own vehicles and have to finance them out of our pockets. We would prefer to have a situation where we have an assigned vehicle and we're assessed on $120,000 for the entire year. But that is not so for all of us. So the private usage, where the private usage is up to 50%, then the amount of the assessable benefit is only $120,000, and that's for the year. Where the private usage is over 50%, then the benefit is still not a significant higher amount. It is $140,000. And you will recall when we looked at the accommodation benefit situation with Miss Maggie Lou, she was in receipt, she had a company vehicle assigned to her, and her benefit would have been assessed to be $140,000 for the year. And if the car is older, if the car is 5 years old or more, then the benefits are reduced as we see here. No. So if an employee is assigned a company motor vehicle, they are to be assessed based on this table. We do have situations where one employee, it might not be very common, but it does happen, where a single employee is assigned more than one vehicles. How do we address that? And the question that you might be asking, can one person be assigned more than one vehicle? They can only drive one at a time. And I would have gone through all of those questions before, but I do know that it does happen. So in a situation where an individual is assigned more than one vehicles, then they are to be assessed for one of the vehicles based on this table. But the second vehicle is to be assessed at market value. The second vehicle is also a taxable emolument, but that now is not going to be assessed on this table here in the second schedule. So you wouldn't have this person getting two benefits at $140,000 per annum. No. The one that the person drives would be assessed based on this table. But the benefit of the second vehicle is to be assessed on market value. And again, market value, what would it cost the person to drive that in terms of rental or lease or that kind of a thing, that kind of vehicle. So that's how we suggest that, you know, you can look at the whole business of assessing market value. All right, so here we go again. Grace is a branch manager at XYZ Limited. She's provided with a 2020, we can up that to 2020 something, 2020 Toyota Camry, which cost the company $8.1 million. Grace uses the car 50% of the time for her personal affairs. What is the taxable benefit in 2021? What is the taxable benefit if Grace uses the car 80% of the time to do her personal business? So in the first instance, she uses the car 50% of the time for personal affairs. The car costs $8.1 million. So here we would go back to the bottom. We don't have to stop anywhere else but the bottom row. The car is for 8.1, which is over 1.5. Now she uses it up to 50% of the time for personal use, then she would be assessed on $120,000. If she uses it for 80% of the time, then it would be $140,000. Pretty simple and straightforward. All right, so that takes care of some of the emoluments that would be addressed in section 5.1c. There are others, ladies and gentlemen. It's just that we cannot, time would not allow us to go through every single one. So 5.1c is your go-to for emoluments that are subject to tax or any special tax treatment. Remember, we said that's one of our objectives, to share that you should understand the legislative references so that in managing your payroll affairs, you know where your first point of call ought to be. All right. So there are some items of emoluments that are exempt from income tax. Now, where these emoluments are usually paid, the ones that are exempt are specified. So they have to be paid under specified circumstance to specified persons in order for them to be exempt. So we're going to start that off. And again, this list is by no means exhaustive. When you go to section 12, you will see other emoluments which are exempt from income tax. For example, you're going to see that the GG, the Governor General, his emoluments, the emolument that he earns under the as a Governor General is exempt from income tax. And there are others, but not many of us on here would be preparing the Governor General's payroll. So what we sought to do was to pick up those that are common, that are, you know, we would be most likely, it is most likely that we'll come across these in our daily affairs. So emoluments, so we are on what is exempt now. Emoluments of a person certified as suffering from a permanent physical or mental handicap. So if there is somebody in your organization who is suffering from a permanent, it has to be permanent now, not a broken arm, not a sprained wrist or an ankle, not a bruise on the foot or something. It has to be a permanent physical handicap. And that has to be certified. The person has to be certified to be permanently or physically handicapped. Right? So even if the person comes to your organization as an employee and you see that the person has only one hand, you don't give the exemption on the basis of what you see in terms of what the person looks like. You give the exemption on the basis of the person providing you with some form of certification, right? To say that I only have one hand. That being said, we move on to emoluments of a person in full-time study at a university or other educational institution. I find that this is more prevalent in government circles, you know, where persons go off on 2 years study leave, and when they come back when they resume duties, they are able to apply for a refund. And that is on the basis that the salary that you would have been getting, which the legislation, if you look at the wording in the legislation, it would say bursary, but it is considered a bursary because you are not going to your office to work, you're going to UE, UTech, wherever else. You're on 2 years, you're on full-time study leave. And by virtue of you being on full-time study leave, you are, the emoluments that are paid to you would be exempt from income tax. Your employer will continue to withhold until you resume. At the time that you resume duties, you're able to claim a refund of all the taxes that would have been taken from your emoluments. And that is grounded in Section 12 of the Income Tax Act. And for those of you who would have been on the session where we looked at the increase in the threshold and the exemptions, age and pension, you will recall that a person who has attained the age of 65 years is entitled to an amount of 207,530 for 2024, right? Because it is, even though the minister would have announced that it is effective April 1, 2024, it is 250, the annual amount is $250,040. We have to prorate that because for the period January to March, it would have been, the amount would have been $80,000. So we take 3/12 of 80 plus 9/12 of 250,040 $250,040. And when we put those together, we end up with an effective amount for 2024 of 207,530. So all a person has to do to be able to benefit from this is attain the age. And further, once the person has attained the age at any time during the year, the person is entitled to the full amount of the exemption. So if the person attains the age in November of 2024, the person is entitled to the full 207, and that is for this year, the full 207,530. Some persons apply it monthly, and nothing is wrong with that. But it should not be looked at as a monthly exemption. And so if you weren't in the organization for January to October, you wouldn't get any exemption for those months. No, once you attain the age of 65 years at any time during the year, even December 30th, December 31st, you are entitled to the exemption, the age exemption for that year. Likewise, persons who are in receipt of pension income are entitled to a similar amount for the exemption. But remember now, you have to be in receipt of pension income. It's not an age thing. It is the fact that you are in receipt of pension income that entitles you to pension exemption. Also, payments made to persons who serve on a part-time basis in the National Reserves. Don't know if anybody from the Army is here. This would be applicable to you. So payments made to those persons who serve as reserves, those payments that are made by the in respect of their National Reserves duties, those are exempt from income tax, as well as the payments that would have been made to them throughout the time of their training. So that takes care of exemptions that we would want to cover. Again, I must emphasize there are others. So if it is that you come across something in your organization and you want to know, first of all, you need to establish that it is an emolument. Once you establish that it is an emolument, you need to make a determination, is this emolument taxable? In order to know if it is taxable, you need to go to section 5(1)(c) to see if there's an exception for it there. If there is no exception at section 5(1)(c), you need to go to section 12. Is there an exemption for it? And if not, then you ask yourself, is this emolument, is there a discretionary provision for it to be not subject to tax, right? So, and that those would be found in paragraphs. When I say those, I mean those that are, the commissioner would give approval for. The legislative authority for that is found in paragraphs 8 and 9 of the second schedule, right? And it says the following allowances may be approved by TAJ, that's commissioner, as being to be paid tax-free. And we talk about traveling allowance and the coding for sales agents. I'm going to talk about coding for sales agents first, and then we go to the traveling allowance. Now, to the extent that a person is a sales agent in your organization and has to travel far and wide, right? It is recognized that that person will incur, that employee will tend to incur more expenses than other employees who actually just sit in the office to do their work. So in recognition of the additional expenses that the sales agents, the persons who have to travel far and wide to carry out their official duties, in recognizing that expense, there is a provision in place to allow those employees to apply to TAJ for coding. Coding is essentially a procedure by which we assess the situation and then we write to the employer of the applicant and say and give approval for a portion of their commission income to be deducted before tax is taken out. So it is where TAJ is essentially a system by which TAJ grants permission to employers to deduct a portion of the person's commission before applying the taxes. So that takes care of coding. So we're going now to traveling allowance. Now, where an employee is required to use his or her own vehicle to carry out his official duties, he's required to travel in carrying out his duties, and he uses his or her personal vehicle to carry out those duties. The employer, no, not the employee, but the employer may make an application to the Commissioner General for approval to pay a tax-free traveling allowance to the employee. We have seen situations where the employees, depending on where they are in the organization, they make the application. That is not how it is supposed to go. It is the employer who is required to make the application. In the application, the employer is required to state the amount of the allowance that he intends to pay, as well as establish the employee's scope of traveling, the frequency, and the geographical area which the person travels. Because we have to establish the fact that this person is really required to travel. It's not a perk. It is tax-free traveling is not a perk. It is not a benefit. It is not intended to be used that way. It is intended to be used as a reimbursement of the additional costs that persons would incur by virtue of them using their personal vehicles to carry out official duties. So where the commissioner is satisfied that the requisite conditions are met, he may grant approval for the tax-free traveling to be paid. And let me just go to the next slide. So the tax-free traveling allowance is intended to reimburse the employer, and this is just for reinforcement because I know I said it already. It is intended to reimburse the employee for expenses incurred in using his or her personal vehicle for official duties. It is to be paid in addition to the salary. It is not intended to be a carve out. It is not intended to be used in such a way where you want to give the employee an increase, but you don't want to pay them any more money. So you decide to apply for a portion of their salary to be treated as tax-free traveling allowance. No, that's not what it is intended to do. right? It is not supposed to be a carve out of salary. So you're getting, you know, $6 million for the year. And come a particular year, you're getting the same $6 million, but an application is made for you to now be paid a traveling allowance. That's not allowed. And that's not how the traveling is intended. The traveling allowance is intended to be used. In fact, that is viewed as more or less an abuse of this privilege. The allowance approved is dependent on the amount requested by the employer as well as the particulars of the employees, right? So we said before that the employer is to apply for the amount which he intends to pay, right? The thing is, TAJ reserves the right to grant that amount or a smaller amount, but apply for what it is that you intend to pay. Any amount that is paid that is not approved or it is paid in excess of the amount approved is subject to tax. So we don't say, Tax Administration Jamaica does not say that you must pay Damian $1,000, $1 million. No, we don't say that. You pay Damian any amount you want to pay. But when you make that application, to the extent that Damian is a traveling officer, when you make that application, we will assess the application and make a determination of the tax-free amount that is granted. If it is that you decide to pay, we approve $800,000, but you decide to pay Damian $1 million, that's fine. Just tax the 200. Because any amount above that which is approved is a taxable emolument. If you go on our website, you will see a technical advisory. I think this one was last updated February 2022. And it outlines the rates, it outlines some of the rules governing how the traveling allowance is to be treated. And if you permit me, I'll just read. I know that you might not be able to read, and I don't expect you to read because I don't want to be charged for any injury to your sight. It says, listed below are the tax-free traveling allowance, which will be approved by the commissioner for use by private sector entities commencing January 1, 2022. The figure reflects the Commissioner General's maximum approved amounts, which will be used as a guide in determining the tax-free portion and does not in any way dictate the amount that the employer is required to pay the employees for traveling allowance. However, TAJ should be satisfied that the amounts approved as best as possible represents bona fide traveling expenses likely to be incurred in the performance of official duties. And that is repeating a lot of what I had said before. It must be to reimburse the employee for additional costs of having to travel. Okay, so again, you might not be able to see this clearly, but just want to point out that these are the amounts. And in your time, you can go to our website. It is right there under publications. When you click on our publications tab and you get that drop down, you get a drop down box, then you can select tax bulletin and it will be right there, right? So you can go and look at it in your own time. The maximum amount that it is possible that we will approve at present, and that is for managing directors or chief executive officer, is $1,697,148. It is not to say that you must apply for that amount for the managing director if you don't intend to pay that amount. Because the other thing that we have observed is that persons will, based on this advisory, persons are of the view that they are required to apply for these amounts. That is not the case. This is just a guide to say this is the maximum amount that we will approve for any category of employees. So apply for what you intend to pay. Don't apply for $1.5 million when you intend to pay 1 million and then use the 500,000 against the salary. That's not allowed. All right. So it is a discretionary benefit that is in place to facilitate and to ease the hardship on employees who have to use their motor vehicles to carry out official duties. All right. So I'm going to stop here and take questions at this point before we move on to statutory deductions. Anybody wants to voice a question? Michael, I see you're hot out of the box, man. Something is burning. Come, Michael, speak to me. Chat with me, Michael.
Good morning. Good morning, everyone. Approaching
morning.
afternoon, but not yet. Good morning. All right. So I want to go back to the person serving in the National Reserve. I
Yes.
just want to understand if they are currently in our employ, but they are reserve. How do we treat the people? We still tax them regularly?
Okay. So I am happy that you have asked that question, Michael,
Yes.
because it gives me the opportunity to go back and clarify what was said. Really appreciate it. So remember now, I'm screening the slide one more time. It says payments made to a person who serve on part-time basis in the National Reserves, as well as the training expenses and allowances paid to him during training. It is only the money that he gets from Upper Camp that is exempt. To the extent that he is employed in your organization and you are paying him a salary, he is to be taxed like any other employee on that on the regular salary. It is only, and remember I said that this would be applicable to the JDF.
Yes.
This is only in relation, the exemption only relates to the money that they get from the JDF, not from their other sources of income. And I don't know if you recall me saying that the exemptions, when we look at the exemptions, they are usually specific to particular situations. So this is specific to the emoluments that they earn from JDF. To the extent that they earn emoluments outside of JDF, that is subject to tax in the normal way.
Thank you very much.
You are most welcome, Michael, and I so appreciate that question. I appreciate all the questions, but that one in particular, because there might have been other persons who might have understood it that way. And, you know, right. Any other question? Timothy, go ahead. Timothy?
Thank you. Yeah, I just got the signal to unmute. Thank you.
Okay.
All right. My question is, I've noticed in your chart here, the managing directors, senior managers, the amount that is stated there. And then down at the bottom, there's also in excess of 200 kilometers, there's a $56 per kilometer on each remaining kilometers. Does it mean that each time the person travels, that person has to do in excess of 200 kilometers, or is it a per month?
No, let me explain that to you now. It says eligible to claim mileage where they have traveled in excess of 200 kilometers in each calendar month. Right, so don't stop at the 200 kilometers. We have to stop
I didn't see
at
that down the
each
bottom.
month.
Oh, thank you. So it's
each month.
so it's in each calendar month. So
Month.
once a person exceeds 200,000 kilometers in each calendar month, that is when the $56 per
And
kilometer.
in addition to the upkeep, they may now get the $56 per km for mileage in excess of 200. So if I am a managing director and I am in receipt of this $1.6 million or for the year, so divide that by 12, each month I get a particular amount, but I don't travel more than I don't travel more than say 100 kilometers, then I would not be entitled to mileage.
Okay.
Right. So for the
Understand.
month, I have to travel in excess of 200 kilometers in order to be able to claim mileage as a managing director.
Okay. All right.
Right.
The other question I had was with the one where I wasn't so clear on it, where the one you were showing about the benefits in a company vehicle, where
Okay.
yes, if you go back.
I'm going right back to it, sir. This one?
Right. I'm not
Right.
so clear about, is it that if the company gives this person a vehicle to use,
Yes.
and the vehicle is used for 50% of their privately, what does it mean? That means that they would clarify this for me, please, because
Okay.
I'm not so
So
sure what
if
it is.
I am given, if an employee is assigned a company vehicle and the employee uses the vehicle to say, well, certainly driving to and from home is not is domestic. But say
Right.
the employee attends meetings once per week somewhere. But in that same week, the employee uses the car to take his kids to school. He uses the car to go to the supermarket. He uses the car to go to church or wherever his place of worship is, or party for that matter. He uses it to go to the beach and to do all his other personal things. Would you say that he has used the car more for private purposes than for business?
Well,
remember, in the context, I'm saying he uses the car to go to a meeting once per week.
Oh, yes, he would use it more for private than for
Right.
business.
Yes. So it is determined on a case-by-case basis, you know. This is something that is managed by the employer. If we are conducting a payroll audit, depending on the information provided to us, it is possible that we may have a difference of opinion or we may agree with you. But this is something that you manage, you determine. So there is nothing upfront to say that you have to travel 2 times to there and 3 times to there, and that to be said to have utilized less than 50% of. We don't get into that. It is something that is managed by the employer, and then on the back end, we assess it. We look at it.
Right. So what I'm trying to understand is that is this percentage saying that 50% private use? It means that 40,000 or 50,000 or 120,000 would be taxable or non-taxable?
No. If the car is used 50% of the time, 50% of the usage of the car is for private purposes. That's what it means. Then you are assessed a benefit of $120,000.
Oh, so that means that benefit no. So if the company gives somebody a car and the car is being used and 50% of the usage of the car or the vehicle is being used for private, then it would be treated as a benefit to the person of 120,000 if the vehicle value is 1.5 and would in turn be taxable. That's what you're saying.
That is it. So the $120,000 here would be a benefit in kind to be accounted for on the payroll as a taxable benefit.
Right. That was what I wasn't clear about.
And I'm
Thank
happy that you have raised it, so now you are clear. And guess what? I know there might have been other persons who could possibly have been in the same situation, so you would have benefited not just yourself, but you would have given me the opportunity to explain again, and for other persons, you know, to get a second chance at understanding. All right, so we have some questions. We're going to take Cindy. Cindy, go ahead.
Good morning, good afternoon, everyone. Can you hear me?
Yes, Cindy, and yes.
Can you go back to the slide with the table that speaks to the mileage? There's something on it that I want clarity on, please.
Okay, I'm coming, Cindy.
Right.
So this one.
Yes. Somebody asked about it earlier, but I just wanted further clarity. I noticed that there's asterisk beside senior managers, middle managers, and the managing director and that speaks to them claiming mileage. So you're saying that those 3 levels of employees can only claim mileage
after 200K.
And that's per month, right?
Right.
Okay, thanks for that clarity. The next one is, I noticed that it also say traveling officers with mileage claim in terms of the amount, the 46 and the 56, but below that it says traveling officer no mileage approved. Is it that if the organization has applied to TAJ for non-taxable traveling for an employee and it has been refused, are you saying that their claims for mileage would be under that particular?
No, there would be the full amount of the traveling allowance for that person would be subject to tax. This, let me just reiterate, this is a guide, this advisory is a guide. Okay. And you are not allowed to pay these amounts tax-free until you have gotten a letter from TAJ to say, yes, you may go ahead and pay this amount tax-free. Okay. So this advisory here is not to be used as permission to pay tax-free traveling. It is just saying to you that these are amounts that these are the maximum amounts that we will approve.
Okay. Because why I'm asking is because I noticed that one says traveling officers no mileage approved. So that's why I was wondering if that is what it means. Because I want to clarify it from my end.
No mileage approved. So when you are making your application, when you go on the tax portal to make the application, one category is with mileage and the other one is traveling officer no mileage. So you decide which one you apply for.
Okay, understand.
Okay.
All right, thank you so much for that clarity.
Okay, you are most welcome. Marvelyn? All right, we're going to take 2 more questions and then we move on. Marvelyn, go ahead. All right. Joy? Joy, I want to hear you, Joy. Yes.
Good afternoon. This that you have up on the screen, does it relate to what? Private sector? Because I thought that with the rolling in for public sector, with the rolling in of the traveling allowance with the salary, the 200-mile minimum, 200 kilometer minimum was eliminated. Is that correct or not?
Those of us who work with the government, our traveling allowance has been rolled into our salary. So this is for the private sector. If you go back to if you go back to the slide before, it says listed below are tax-free traveling allowances, which will be approved by the Commissioner General for use by the private sector entities.
Okay then. All right,
All
thanks.
Yes, but thanks for that though.
Yeah.
Yes. All right, one more question and then we move on to statutory deductions. I know I don't want your lunch to get cold today at all. Who? Nadine Gordon. Nadine, go ahead.
Good afternoon. I was like, oh, please call on me. All right. I have two questions, right? And this is from government in the government sector. I know there are other persons on here that are not in the government sector. But what I was asking is that for this thing that you have up on the thing, what with the new compensation, we know that government employees no longer get motor vehicle upkeep. And the mileages are different. It has also changed that whether or not they are assigned company-owned vehicles, and we know that that is just for heads of entities and some senior government positions. So all of this no longer applies to government employees. Correct?
That's right.
Okay. So just making that clear for all the government employees who were not aware, this no longer applies to you. But what I wanted to ask specifically is could you go to the one that you have for people on full-time study? Being exempt?
Okay, so you're talking about the exemption. Yeah, go ahead and ask the question.
All right. I just wanted to be clear. While they are on full-time study, we in the payroll department must no longer charge them tax for that?
No, that's not. They will continue to pay tax for the duration of their study leave until they resume. It is when they resume that they get to claim the refund.
Oh, okay. So we continue to charge them the tax
That's
that they
correct.
and that is PAYE or all tax
All
types.
the statutories, they continue to be assessed for taxes and contributions in the normal way.
So and that
until
is
they
even
resume.
all right. Thank you for that. Really
You're
appreciate
most
it.
welcome.
And also one final question, and this is even if the course of study is fully being borne by the employer.
So hold a minute. No, you're saying that so we need to now assess the situation, because what is the bursary? Is the bursary just the salary, or the person is being paid the salary plus their tuition is being paid by the employer? That's what you're saying?
That's what I'm saying.
Then the bursary would be the combination of both. And so both would be accessible to tax. Because remember, there is nothing unless there is some legislation that says that the tuition is not subject to tax. Now, based on the definition that we had of emoluments, that would be brought into the scope as emoluments, right?
So therefore you're saying, but for example, say they didn't ask to go to school, and you as an employer saying, you know what, I need you to do this course of study because it benefits the employer. Of course, everything benefits the employee ultimately, and you're bonded and everything. Must they still be taxed on that?
If it is, but the whole issue of the bonding means that this person must serve
2-3 years, depending on
years,
government.
which is
Government
pretty
has
similar
these periods based on the value.
All right. On the face of it, I would say the bursary, it sounds to me like the total cost that the employer is incurring. But I would we could speak some more about that to see what other specificities that would need to be borne in mind. But on the face of it, it would be a part of the cost to the employer. And it
To
would
the
be,
employer, yes.
yes.
But is the employee,
And if the employee decides to leave the organization
they would have to pay it
after
back.
serving the bond. So
Oh,
well,
after serving the bond. Okay.
no, if they decide to leave before they serve the bond, they have to repay what the employer would have paid them, right? Paid in respect
Right.
of studies.
Yes.
And I think that is speaking to the fact that it really is a part of it ought to be considered in determining the amount to be assessed for tax, because it's not going to be treated any different than what is being paid as the regular salary. But what happened is that we could have a discussion, further discussion on that. When we have specific situations like that, in situations like these, I don't like to make public pronouncements.
Agreed. Yes.
There be something that spins the case in either direction.
Okay.
And so I would not want to make a pronouncement. It sounds, generally speaking, it sounds like it should be a part of the emolument to the person, but I would want to look more at more specifics around that situation.
Okay. All right.
Because we have to guard against, everybody running away from here to say that that is the situation, because it might not necessarily be so in some cases. Yes.
Okay. Understood. Understood.
Yes.
I'll reach out further.
Oh, sure. Definitely. Feel free to reach out to myself or any other technical specialist or corporate office. We'll respond.
Okay. All right. Then.
Thank you for that intervention, though. All right. So we're going to be moving on now to statutory deductions. And I'm sure that we all are familiar with those. We see them on our pay advices. We apply them daily in our jobs, right? So we can go through this part of it fairly quickly. So statutory deductions are amounts that employers are mandated by law to withhold from the taxable emoluments of their employees and remit to TAJ. So it is required by law. You don't have a choice. And it is not for the employer to have the employee sign and a contract to say that he is personally responsible for his statutories. That contravenes the income tax law and ought not to happen. It will not be honored in a court of law. The employee is not in a position to sign to say, I am responsible for my statutory deductions legislatively. Once the person has an employer, the employer is obligated by law to make these deductions and pay them over. And we just want to touch back base with paragraph 7. I mentioned, I referred to it earlier, where paragraph 7 of the second schedule to the Income Tax Act stipulates that employees are required to withhold, to deduct or repay income tax in respect of emoluments paid to employees during the year. And that's about the 100th time that I'm repeating that, because we have seen when I was in audit, I remember in the case of several payroll audits, I would see employers pulling out these agreements that they have with employees to say, we're not withholding because this person is required, has agreed to take care of his own statutories. That is null, that agreement is null and void and will not hold up in the court of law. So we spoke about withholding in respect of income tax, and that is Regulation 7 or paragraph 7 of the second schedule. Now, what about of the other statutory deductions? Now, the NIS Act, the NHT Act, and the Education Tax Act, all of these, they stipulate that the provisions of the Income Tax Act or any regulation thereunder concerning the payment, collection, and recovery of income tax also apply to these statutory deductions. So you will not see in the Income Tax Act any provision that says that the taxpayer, the employer is to withhold NIS, because it's not an NIS Act. The NIS Act stipulates that all the provisions governing the withholding under the Income Tax Act also applies to NIS. The NHT Act does the same thing, and the Education Tax Act does the same thing. So, employer, you are required to withhold. And of course, these are, the logos for the various statutory deductions, which you are quite familiar with. We don't have to detain ourselves there too long. All right. Moving right along. Right. So we're now going to move to the age limits for the various contributions. So, ladies and gentlemen, we would have looked at what constitutes employment. Then we look at emoluments. When is the emolument taxable as opposed to when it is not taxable, or when it's just a part of it is to be taxed? Then we are now on to statutory deduction, because the statutory deductions are to be applied to emoluments that are subject to tax. But there are some administrative rules that must be observed in applying those statutory deductions. Right. So for NIS, the age, you pay NIS between the ages of 18 and 70 years. Well, the retirement age is really 65 years. But there is no, the deemed retirement age is your normal retirement age plus 5 years. So you're deemed, and you pay NIS for as long as you have what the NIS Act terms as insurable income. For as long, and employment income is certainly an insurable income. For as long, so to the extent that you are employed to an organization, and you have attained the age of 65 years, but you continue to work beyond 65 years, you will be required to continue to pay NIS until you have attained the age of 70 years. There is a little variation with that as it relates to some women, because there was a time up to 2011, women would retire at age 60, while men would retire at 65. But there has been a phased increase of the retirement age for women between 2011 and 2021. And so you will find some women with a normal retirement age that is less than 65 years of age. But whatever the normal retirement age is, the deemed retirement age is that plus 5 years. So if my normal retirement age is 62, if I retire at 62 as a woman, my deemed retirement age would not be 70, but it would be 67 years old. And I hope you understand that. In respect of NHT, you pay NHT between the ages of 18 to 65 years, regardless of your source of income, regardless of whether you continue to work beyond 65 or not. The cutoff is 65 years. In respect of education tax, you pay education tax between the ages of 18 and 65 years in respect of employment. Now we're talking about employment, but I just decided to tuck in self-employment because there are a number of employed persons who are also self-employed. There is no upper limit, age limit for the payment of education tax for the self-employed person. So if you are employed and you have, say, rental income, you would pay education tax on the employment income up to age 65. But as it relates to the rental income, you'd continue to pay education tax for as long as you have that income. For PAYE, there is no age limit to the payment of PAYE. Income tax has no age limit. Once you're in receipt of income, because it's not the person that is being taxed, it's the income. There is no age limit to the payment of income tax. So if you are below 18, any year, any age, and you are in receipt of income, meaning you are, it is subject to tax. Of course, the whole business of you getting the threshold and all of that will apply, right? But there is no age limit for the payment of income tax. HART is not an issue because HART is not paid by the employee, it is paid by the employer. In respect of the rates, the current rate, NIS is 3% for the employee, 3% for the employer. Now, NIS is paid on gross, but it is gross up to $5 million. So there is nobody in Jamaica, regardless of how much they earn, who is required to pay NIS of more than, on income more than $5 million. NHT is 2% for the employee and 3% matching contribution for the employer. This is on gross. There is no cap. So if your gross is, whatever your gross is, you pay 2% of that for your for NHT. For education tax, you pay tax on statutory income. Now, whereas for NIS and NHT, it is on gross, for NIS, for education tax, it is paid on statutory income. Now, what is statutory income? So statutory income is your gross income less all allowable exemptions and deductions, right? And so some of those that we would have made mention, certainly the NIS. So you would, if you would start with your gross, you deduct your NIS. And we mentioned before that to the extent that you're in receipt of age and pension exemption, those would be taken out as well. And you'll see, we mentioned this morning as well that the amount of money that you use to purchase shares under the ESOP plan should also be deducted. So you take out all of those things in order to arrive at your statutory income. And then you apply 2.25% for the employee and 3.5%, match that with 3.5% as the employer. Now for PAYE or income tax, the individual has a 3-tiered rate structure. But before I go to the 3-tiered rate structure, I just want to point out the fact that education tax and income tax, they are both paid on statutory income, not gross. They are both paid on statutory income. And let me say, that anything that removes all of your income, so to the extent that you have exemption that wipe out your total income, it means that your statutory income would be 0, right? And so you would not be required to pay education tax or income tax, because both of them are computed on the same base. Now, PAYE, the individual, for PAYE or income tax, the individual has a 3-tiered rate structure. And what that means is that for up to the threshold, so right now the threshold is the new rate since April 1 is $1,700,088, but because we have to also account for, you know, the 3 months, the first 3 months at the old rate, then we know that the threshold, the effective threshold for 2024 is actually $1,650,090. So every dollar up to, for 2024, up to $1,650,090 is subject to tax at 0%. Every dollar above the threshold up to $6 million is subject to tax at 25%. And every dollar of statutory income, remember we have to keep in mind that the base here is statutory income. Every dollar of statutory income in excess of $6 million is subject to tax at 30%. Now, one of the questions that we tend to get a lot here is, do I have to wait until the employee has reached the $6 million mark before I start to apply the 30%? And the answer to that is no. Any month that the person, so $6 million divided by 12 is 500,000. So any month that the employee's salary or employee's statutory income exceed 500,000, which is 1/12 of $6 million, then the 30% rate of tax is applicable for that month. Because payroll is computed on a cumulative basis, it will automatically adjust itself, right, over time. But any month, in any month that an individual's statutory income exceed $500,000, which is 1/12 of $6 million, then the 30% rate applies. And we spoke about threshold already, so we're not going to be staying too long here. Just to say that the threshold is not available to non-residents. So if somebody is a non-resident, meaning that they would have been in the island for 6 months or less, for less than 183 days or 6 months, then the person would not be entitled to any threshold. Neither would the person be entitled to pay tax at any other rate apart from 25%. So if a non-resident earns $100 million in the time that they remain a non-resident here, they would not be required to pay the 30% tax on any part of their income. And so it is only the 25% rate of tax that would be applicable. And we have been talking about this, and many of you would have been on the session before, and I made mention of the 1,650. How we arrive at it, we take 3/12 of the old rate, which is 1.5 million and $96, and we add that to 9/12 of the new rate, and that gives us a total of $1,650,090. And of course, the fortnightly and weekly amounts are shown here on this slide. Weekly is 28,848, fortnightly 57,696, and monthly 125,008. And that would be it for January to March. Now, for the period April to December, the weekly threshold would have been increased from 28,000 and change to $32,694. The monthly threshold would have increased from $125,000 and $125,008 to $141,674. Now, the fortnightly, as I would have explained in sessions before, is the one that may have a little variation. But the bottom line, ladies and gentlemen, is that the total threshold for the fortnightly paid persons must not, under any circumstance, be less or more than the $1,650,090. And so to preserve that, what we show here on the table for the fortnightly persons is that at 65,195, well, how we arrive at that is that we would have utilized, taken the total for the year into consideration, and then we subtract what would have been taken for the period January to March, and then the difference is divided by 20, because we would have had 6 fortnights in the period January to March. And so for the period April to December, we would have 20 fortnights. So we subtract what has been taken for the period January to March from the total that the person is supposed to be entitled to for the year, and then divide the difference by 20, and that's how we would have arrived at the 65,195.70. As of 2025, the full amount of the threshold of 1.7 million will apply, and then we will have nice smooth figures of 32,694 for the month, 65,388 for the fortnight, and 141,674 for the month. All right. In ascertaining statutory income of an employee, the following deductions: income tax paid. So the income tax contribution paid to national insurance, that is section 13. So section 13(1)(p) is our authority for deducting NIS in computing our tax liability. And I did mention before that monies that are used to purchase shares under the Employee Share Ownership Act is also deductible. This now, section 13(1)(i) speaks to contribution to a pension fund. Pension income at the end of the day, when the employee starts to receive the pension income, that is subject to tax. However, when the employee, during the years when the employee would have been contributing, making the pension contributions, those contributions were taken out before the tax was applied. So they get the pension contribution as a deduction before the tax is computed. So an employee's contribution, this is what the legislation says, shall not exceed 10% of his annual remuneration, right? General rule. The employers may contribute, the employer's contribution in respect of the employee shall not also exceed 10%. But where the employer has contributed less than 10%, the employee may pick up the difference and be allowed to get that as a deduction. So if I would normally contribute 10%, my employer says that he cannot contribute more than 5%. What we have, the statement in the green here is saying that I can now say to the employer, all right, deduct the difference from my salary of 5%, the difference between the 10 that you are, the maximum 10 that you would be allowed to pay, and the 5 that you are actually paying. So the employer can pay a maximum of 10, but the employer chooses to pay only 5. The difference of the 5, the employee may pick that up and get it as a tax deduction as well, or a deduction before tax. In the same way, if a person contributes to an approved retirement scheme, say you are working with an organization that does not have a pension fund, and as an employed person, you choose to participate in an approved retirement scheme, the contributions up to 10% of your emoluments would be allowed as a deduction as well. And you're not legally allowed to participate in both a pension fund and an approved retirement fund at the same time. All right, we're coming down. I think we will move to the last scenario, we'll go through and just do that one, and then we'll break for the day. So we're going to now do this exercise just to see, to demonstrate how the statutory deductions are applied. We are mindful of the fact that taxes, payroll is computed on a cumulative basis. This is not to show that, it is just to show how these statutory deductions are applied. And I'm going to go through it with you. So also, let me go back to the scenario. Connie Bright is employed to ABS Limited. Her gross salary was $875,000 per month for the month of April 2024. She contributed 10% to an approved retirement scheme, and we're to now calculate the relevant deductions and ascertain her net pay. So we're going to move to that quickly. In the interest of time, I'll just work through that with you. So for the month of April, total emoluments, gross pay is $875,000. We were told that she contributes 10% makes a pension contribution of 10% of her gross. So that would be $87,500. And remember, we said that all those things are taken into consideration in arriving at the person's statutory income. And that's where we're heading here. We want to arrive at the statutory income so that we'll have the figures to compute the education tax as well as the income tax. So the aim here, we deduct the pension contribution. Then we also now deduct the NIS contribution. Now, remember we said that there is a cap on NIS, on the gross salary. So, and you pay NIS on gross up to $5 million for the year. So when we're computing the monthly payroll, we would now have to be required to divide the $5 million by 12 in order to arrive at the monthly ceiling. So when we do that, we see that the monthly ceiling for NIS is $416,666.66, right? 66 cents. Now, we would want to pay attention to the fact that the gross for the month, the total gross was $875, but this person is not going to be paying NIS 3% of the $875. They pay NIS on 3% of the ceiling, which is $416,666.66. And so we take 3% of that, that's $12,500. In order to arrive at the statutory income for the month, we now subtract the pension contribution and the NIS contribution from the gross, and that gives us statutory income of $775,000. Now, education tax is 2.25% of statutory income. So when we apply that, we get $17,437,050. We did say that NHT is 2% of gross. So we are going to now take 2% of 875, the 875,000. And that gives us $17,500. Then now we are now at the computation of the person's income tax, PAYE, if you may. So the monthly threshold for April 2024 is $141,674. So of this $775,000, $141,674 is going to be taxed at nil. So the tax on that is 0. Remember we said that in the month, I beg your pardon. We would have said earlier that statutory income in excess of $6 million is to be subject to tax at 30%. But we are working with a monthly cycle here. So we will translate that to mean statutory income in excess of 500,000, which is 1/12 of $6 million, is subject to tax at 30%. So what we do for the 25% is the 500. So if everything above 500 is to be taxed at 30%, then the 500,000 becomes the amount that is subject to tax at 0% and 25%. We know how much is subject to tax at 0%, so we subtract that from the $500,000 to arrive at the amount of that is subject to tax at 25%. So we see here when we apply the tax rates that at the 25% band, the tax payable is $89,581.50, and the tax payable at the 30% band is $82,500. Right? And so the person's total deductions for the month would be all of what is in my column here to the right, and the total of that is 307,019. You subtract that from 875,000 and you're left with 981, and that is what Miss Bright would go home with as her net pay. I am going to give one more opportunity for a few more questions, about 5 questions tops, and then we close off. I know it has been a long journey, but I hope a fruitful one. I have personally enjoyed it. I trust you have too. Do we have any questions? Maureen, go ahead. Maureen? Next person? Anisha, go ahead.
All right. So the first one. All right. So in this calculation, you're using gross pay.
Right.
Question I have, somebody's salary is broken down in basic salary, discomfort allowance, duty allowance. I'm giving just some examples. The pension contribution, and they say the company has a pension contribution, 10% like you have there, just the same. What total do we find that 10% of?
All right. So what does the pension, what the rules governing the pension would determine what the pensionable income is. And so, right, you would look to that to make that determination.
Okay, all right.
Rules
So
governing the pension fund.
All right. The second one.
Yes.
I previously had an employee who did not enroll in the pension that we had because she had one externally, say from Scotiabank.
Right.
She provided a documentation from them to say it is a pension fund. How do I know what to deduct before taking income tax? Do I need to ensure that it is less than 15% of or gross or what?
Okay, so the document that she would have taken to you, there should be documentation as to how much she will be contributing to that fund. But the thing is, you may allow up to 20% of her, of the person's emoluments. So it's up to, so if the person, say the person is earning $100 per whatever, per month, you may allow up to 20% of the $100 as a deduction. But the person also needs to prove to you how much he or she is actually contributing. Because then what you would do is allow the amount up to the 20% of the salary. So the employee would need to provide you with some details.
The only thing I got was the amount that was being deducted.
All right. So I am saying the amount that as an employer, you have presented to us a scenario where one of your employees is participating in an approved retirement scheme at Scotia.
Right.
And I'm saying legislatively, as an employer, you are allowed to deduct up to 20% of the person's emoluments in computing his tax liability. However, that's a cap. So you would need to know, find out from the employee how much, or get proof, not just word of mouth, get proof as to how much a person is actually contributing to the fund.
When you say actually, you mean?
All right. So suppose this person is contributing $25. So the person's salary is $100. You legislatively are allowed to make a deduction of up to 20%. So that would be $20. If the person is actually contributing $25 to the approved retirement scheme, you would now not be allowed, you would now not legislatively be required to make a full deduction for the $25 because the ceiling set by the legislation is 20%.
Okay, got it then. All right then.
Okay,
Right,
great.
thank you.
You're most welcome. Sammy Joe, go ahead.
Good afternoon.
Yes.
So there was a question in the chat in relation to persons who are employed part-time, but they are working remotely in the US or Canada.
That's a popular one these days.
That would
All
be
right.
primary
So what
person.
is the question though? Well, let me not preempt you. What is the question?
Okay, so our organization, for example, has some persons who are engaged in a contract of service with persons who are non-residents of Jamaica. And persons who are also residents, well, dual residency or dual citizenship. How do we treat the income for those persons? Do we tax it or do we just send the money off to them?
You say some person. Are you an accounting firm?
No.
Are you from an account? Are you providing accounting services, payroll services?
No.
All right. So I'm trying to understand the context in which the question is being asked. But are you an employer?
Yes, we're an employer.
Yes.
And we're in the education sector. And so there are some persons who we may need their services to facilitate courses, to teach courses, but they're not in Jamaica. So they teach online classes, they're not in Jamaica.
Oh, so the bodies are not in Jamaica.
That's correct.
Okay. So they earn income here in Jamaica. As a non-resident under Section 5, you are subject to tax on, if you are a non-resident, you're subject to tax on income earned in Jamaica. Right? It is employment income. Employment does not have to be continuous. It does not have to be full-time.
Right, it's not full-time.
No, and I'm saying employment does not have to be full-time either,
Okay.
right? So employment on a contract of service, remember that's where we started this morning. Do you provide any direction, supervision, and control over what these people do?
To an extent, we
You
do.
set the class
We
time?
do
Is it
provide
that
them
they
with
decide whenever
deadlines.
they come on to do the classes? Or
No,
you
we set
have
the
your
time.
established class schedule?
We do have our established class
And you say
schedules
to them, you must submit grades by a
by
particular time.
XYZ time.
Yes, so there is direction, supervision, and control. So you are required to assess them for tax.
But how does that work though, if they don't have TRNs and stuff like that? Are they required to get them?
Well, they would be required to.
Okay,
They would be required to.
thank
It
you.
is employment. That again is a situation that it sounds a little surfacey to me, and I would want to delve a little more deep. I know I'm telling a lot of persons that, but I would want to look a little more closely at that one as well, because on the surface of it, it is employment. And there is nothing that exempts or excludes that income from tax. So it would be subject to tax, right? So if it is that persons need to get a TRN, then that's just what they have to do. Any jurisdiction, if we go to the US to work, we have to do what Uncle Sam says that we're to do in order to function in that environment, right? Or anywhere else.
Right. I also
Yes.
have another query. How does, in a nutshell, or as summarized as possible, does the double taxation treaty works? Or would there be any relation to
Okay.
this type
So
of
yes, excellent
situation?
question, excellent question. And I thank you for that. So the fact that this non-resident is earning income in Jamaica would mean that under the Income Tax Act, they would be subject to tax. However, if there's a double taxation treaty in place with the jurisdiction from where this non-resident originates, or where this non-resident is a resident, the person is non-resident in Jamaica, if there's a double taxation agreement between Jamaica and that other jurisdiction, then the provisions of the double taxation agreement would take precedence over the Income Tax Act. So we'd have to now look at the double taxation agreement to see what it says about employment income, because nothing has changed. It's still employment income. But what does the double taxation agreement with that jurisdiction say? Who has the taxing right? Is it Jamaica? Is it where the person is from, or is it shared? So that's something I am happy that you would have brought that in the picture.
Okay, thank you. And I have just another small question. So we have some retirees, but the pension fund is not administered it's not approved by the Commissioner General. But we, the local company, would disburse the pension to the worker. Are we still required to pay hard tax on the pensioners? So we have pensioners and we have them in a payroll cycle. Are we still required to pay hard tax for them?
All right, what does the Heart Act say? Is there any exemption under the Heart Act? All right, so, and I'm just I haven't looked at the Heart Act in a little while, but pension income is emolument, right? Hello?
Yes, it is.
It is emolument. Does the Heart Act, so we would need to go to the Heart Act and see what it says about the base on which the 3% is to be computed.
Okay.
So let's use that as a guide.
Okay.
Right. So the
Thank
answer to
you.
that is going to lie in the Heart Act. Yes.
Thank you.
Yes. Antoinette, go ahead. And we'll take 2 more after Antoinette.
Oh, I'm sorry.
Oh, I'm told we have 4, 5. Okay. So we're taking 5 more questions, starting with Antoinette. Colin. Go ahead, Colin.
Yes, hello?
Yes, Colin, go ahead.
Silly question. What's the
No,
difference?
I disagree. Let me disagree with you up front, Colin. There is no such question in any session that TAJ would have put on for our customers.
All right. Difference between a pension fund and a retirement scheme.
The difference?
Yes.
All right. Again, the pension fund and let me go with the similarities and then we go with the difference.
Fine, good.
The similarity is that both funds provide income at the end of your work life or at some fixed time in your life, right? So that is the common thing. Now, a pension fund is usually a group fund initiated by, say, an employer. So an individual cannot participate in a pension fund. It would have to be a fund established by an employer for a group of persons, right? The approved retirement scheme, on the other hand, an individual can approach any one of those financial houses. I know Scotia Bridge, I think Sagicor has one. I know NCB. So an individual can approach any one of those providers and personally participate in that because they now put you in a group.
Okay, okay.
Right? So that's in essence, there are other differences, but that is what comes to mind. The whole business that the pension is usually associated with employment and is usually like a group fund that the employer decides to have administered to pay a benefit or to pay income to their employees at the end of their work life. The other one is an individual, is a plan in place to not have the self-employed person being disenfranchised or somebody who would not have the benefit of their employer establishing and administering this fund.
Okay. I get the difference now, more like for self-employed. I understand.
It's not just for self-employed, you know, because remember I said that if you are employed and your employer does not operate a pension fund, you can, as an individual, approach any one of these entities and participate in an approved retirement scheme.
All right. Thank you very much. I
You
understand.
are most welcome. Michael, go ahead.
Yeah, good afternoon again. Thanks.
Good
Okay,
afternoon,
just
Michael.
seeking 2 clarifications. Really approved retirement fund. You said that the ceiling for the percentage is 20%. And the question was asked if the person comes and we work it out with a deduction already paying 25%. How do we treat it? We just take the 20% portion that we would only account for?
Yes, because the legislation does not give you the authority to go beyond the 20%.
Okay.
So you have to work with, as an employer, you're required to work with the legislation. The person may be contributing a lot more than that. What if it's a person who can contribute more, can afford to contribute more? And
Yeah.
to be honest, it is in the best interest of the, I guess there are rules governing the
Yes.
contributions, right? But it
Right.
would be in the best interest of the employee to contribute as much as he can, because what he gets at the end is going to be a function of what he puts in.
Right. Yeah.
But for tax purposes, the deduction
20.
is restricted to 20%.
Fine, thanks. So, all right. The next one is that for the employee, whereby the employer only contributes 5 of the full 20. You're saying that we can contribute that extra 5.
Right. So employee is by law, employee contributes 10, 10, employer contributes a maximum, matches it with a maximum of 10.
Right.
And I'm saying where that is done, the employee gets his 10 that he contributes as a deduction.
Right.
But the legislation also allows for a situation where if the employer contributes only 5 of his 10,
Right.
the employee may pick up the slack for the other 5 and contribute that, and also get that as a deduction in computing his or her income tax liability.
All right. Thanks very much for that clarification.
You are most welcome. Joseph? Next.
Yes, good afternoon.
Good afternoon,
Right.
sir.
Situation. As it relates to gratuity, no. General rule, gratuity is tax-free, general rule. I mean, assuming that somebody's in a contract for, let's say, 2 years, and that's this contract that they sign, that they get their gratuity at the end of that period. So let's say that that is in place. However, the funding agency or whoever it is that is paying it for decide to close down the project earlier than the 2 years. In other words, then the employee didn't opt out to then pay the tax, because if you jump out before the 2 years, you'd have to pay the tax on it. The funding agency decided to close it down before the 2 years. Would that person still have to pay the tax in that they weren't the one that
Okay. All right. So first of all, you said that this payment is being made out of the consult fund, right? Is that the case?
necessarily,
approved?
not necessarily.
All right. So there are perhaps we need to establish the circumstances under which this payment is being made. So the person is not being paid from the consult fund or an approved an approved fund.
A funding agency, an international funding agency. However, they've come under the government of Jamaica through an agreement. Let's say they were, let me just give something. Let's say that they were looking about persons who have contracted poliomyelitis. I'm just picking something weird. And and the persons have been given contract to work for 2 years, and after the 2 years, they would have been given their gratuity, which is tax-free. Let's say 20-25% of the total earnings over the period. However, 1 year in, the funding agency decided that, you know something, we think we better stop this. We're not going to go for the whole 2 years, so we are going to shut it down. The person still entitled to their gratuity, but should they be taxed, seeing that the employees were not the one who decided to opt out, but the funding agency decides, so I'm closing it. Not sure if you're understanding the question.
Yes, that sounds like one that I would want to have some discussions with you on, but if you're saying it's not being paid out of the consolidated fund.
Not necessarily. I'm trying to be I'm trying to be
so
as
then right, but the person would not have met the 2-year criteria as is stipulated under the ministry circular number 12, I think it is.
Yeah, but not their fault.
Right. No, man. I'm following you.
Yeah.
So ministry circular number 12 says that you need to have served for 2 years before you would be eligible for the gratuity, right?
The
And for it to
tax-free
be
part.
the tax-free part.
Mhm.
Ah, all right. The fact that it is not being paid out of, I'm going to defer the answer on that. I don't want to mislead you.
All right. I want to give you my contact information. I'm not sure if you have
Sure.
it. So
And
you
then
can.
we'll have a discussion around that.
All right.
Because if it is not, I guess there are things that you would not want to say on here, and I would not want to delve too deeply into that in
That's
this forum.
correct. That's
That
correct.
is correct. And so I feel like this is one that needs, you know, more, there are more questions that I have, but
Yeah.
I'm sure.
How will I get my information to you? I went into the chat to send it, but I'm not sure I can type something
All right,
here.
you can send an email to Colleen.Williams
Colleen.Williams. One of my staff, please take that. Okay,
at TAJ.
Let me spell it out proper. COLLEEN.
Two L's and two E's beside each other.
Dot Williams.
Williams.
Mm-hmm.
TAJ.
Mm-hmm.
.gov.jm.
Thank you. Okay.
Yes, sir.
All right. Thank you.
All right. Yes, we will talk some more about that. Colleen is on again. Colleen. Yes, go ahead, Colleen. I hope you spell your Colleen correctly, you know, Colleen.
It's spelled correctly, same as yours.
Good girl. Good girl. Good girl. Good girl.
All right. I have a question regarding the motor vehicle taxable benefit. If a company leases a vehicle, they do not intend to own the vehicle at the end of the lease. They are not responsible for maintenance or insurance, and the vehicle is being used by an executive. What will be the taxable benefit? The lease payment or based on the schedule?
All right. So regardless of how the company would have acquired the vehicle, the company has made this vehicle available to this person for usage. The person would be assessed based on the schedule.
Okay.
Not on the lease payments.
Okay. Good.
Because if the employer could have bought the vehicle, that the purchase price would not have come into question here. It's come into play in determining the benefit. And so the method of acquisition is of no moment in determining the benefit.
Okay.
Okay. Antoinette, go ahead. What number are we now? I'm mindful of the fact that persons might need to go for lunch.
Or afternoon.
Good afternoon.
Just to follow up on that question. So the lease amount would be used to determine the benefit, meaning, so we have in this schedule the cost, so we say over 1.5, and that is, so in terms of a lease, seeing that it is paid monthly, how would you, say for example, you pay $1 million monthly, argument's sake, or 100,000 monthly?
No. So it's not the lease payment. What's the value? What's the value of the vehicle at the time of at the acquisition?
So we're not. So it's a lease.
Because you're going to now be paying lease, the principal plus interest.
Right.
Right.
Right. But remember, the lease is based on a monthly. So we don't acquire the vehicle. We lease the vehicle for a monthly fee.
Mm-hmm.
Right. So is it the monthly fee times 12? What do you?
No, but it's
is the NPV based on how we recognize it on the balance sheet?
I guess it would be, well, we would move to what's the value of the vehicle? What would it cost to buy that vehicle? Because if you go to it's not lease payments, to use the lease payments, I'm just thinking there's an interest component in that.
So Colleen, so what I'm thinking is so we would have recognized, depending on the tenure of the lease and value, would have recognized it on the IFRS 6. 2016 and would have put asset value on the balance sheet, right?
Yes.
So I'm thinking, is it that value we use or the lease payments? I'm trying to.
All right. It would seem to me though that we would be what you're trying to what you're trying to establish there is which one of the bands you would choose to assess the benefit.
Yes.
Right. And from where I sit, more than likely it is going to come out at that last value band anyway, any approach you take. Oops, I am sorry. Okay. Any of them, but it is really, if you were to acquire the vehicle, what would it have cost? That vehicle is, you buy a Honda.
Yeah, more than 1.5.
A Honda CRV from ATL. What would I'm saying? This gives a guide. It says over 1.5 million original cost. It says original cost. That's what is to be used, original cost. I understand that in a lease situation, you would not have bought the vehicle. But it's not something that the other thing is the value that is used here is not something that changes from year to year. You get what I'm saying? And so you run the risk of getting a different value or a different cost if you were to use the lease payments over time. Right? So for that, I would say go with what the vehicle would, because even if it is going to be the cost plus interest that you're actually paying out in your lease payments, right?
Right.
Yes. So try to ascertain the cost as best as is possible, as the legislation speak to the cost. Yes.
Okay, thank you.
Yes. All right. So we're on to question number 3 or 4. That's the last one. Okay. So I thank you very much, ladies and gentlemen, for your time and, your participation. I would have enjoyed the session. I want to say special thanks to my participants. Many thanks to you. The session could not have been what it was without you. I'd be just sitting here in the room talking to myself and nobody would respond to my questions, right? So I really appreciate the fact that you took the time out. I trust that you would have benefited from the session. And just to encourage you to keep your ears to the ground from time to time, we will have sessions like these, probably on different topics, but yes. So just to remind you that there's a webinar on tomorrow that will be, and in that webinar, we'll be focusing on the increased threshold, age, and pension exemption. But the focus group for tomorrow is really the pensioners and the golden agers, persons who manage pension funds. That's the focus. Those are the focus. That's the focus group for tomorrow, right? On the 13th of this month, we will be hosting another webinar on the same topic that we dealt with today, administration of payroll taxes. The content will be the exact same thing. So if you have benefited today, we encourage you to tell your friends who were not here today and encourage them to sign on for the discussions that we will have so we can chat, right? Yes. So we will also be streaming live tomorrow on YouTube. So for those persons who do not get to register, you won't be left out of the loop at all, right? And for today, we understand that some persons would have been on YouTube. Thank you for joining. You know, we really appreciate that you came and you stayed, and trust that you too would have benefited. So, ladies and gentlemen, I just want to say thanks to my team here, my VEST team, my virtual event support team. Many thanks to them. I want to say special thanks to my chat monitors. You did a fantastic job. I know you must all be tired now, and I'm going to release you. So thanks to you. Thanks to everyone who would have participated to make this a successful event. God bless you. Have a great afternoon.